The data be more messy and more complex.
The consumer is still fragile, and that consumer confidence has been a cautious point.
This earnings season, we saw that corporates were pretty cautious.
Tariffs will push up inflation, and that probably happens faster than any hit to growth that we're going to see in the hard data.
There's also a distinction here between when the market stops caring, but the economy is still going to care.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday following a major market rally, President Trump landing in Saudi Arabia hoping to secure as much as $1 trillion in investment commitments as back home Republicans make his campaign promises the centerpiece of a signature tax package, and Buy America makes a comeback. China removing a month-long ban on airlines taking delivery of Boeing planes. It's Tuesday morning, and heads are still spinning on Wall Street.
Yeah, Peter Tchir yesterday led the charge saying, was it all just a bad dream? And frankly, the answer from some people was maybe. I mean, basically this morning what we've gotten is a slew of upgrades. David Kostin over Goldman Sachs upgrading to 6,500, the year-end target for the S&P 500 from 6,200. You have Max Kettner saying dilemma solved, clear upside risks for now, but for how long? And have those upside risks already been priced in?
The S&P this morning down by 0.25% since April 2nd. The S&P 500 is higher by 3%. This market is treating April 2nd as a one-off event, totally recoverable, and with limited scarring. Is that the right way to look at April 2nd?
It's a perfect way to frame it ahead of a CPI print in the United States at a time when that is really the concern. Do we get maybe faster growth than they would have otherwise gotten had the worst case scenario gone into effect? But do we get inflation that still is elevated, really tying the hands of both the Federal Reserve and a lot of companies looking to expand? A lot of people saying, no, not everything is back to the way it was before April 2nd. The damage is limited, and on a relative basis, it is better news, which is enough to engender the rally that we've seen.
Big rally in yesterday's session this morning, taking some heat out of that move. We're down by about 1/3 on the S&P 500. Lisa mentioned Pete. In just a moment, we'll catch up with Peter Tchir of Academy Securities following a major market rally in the last 24 hours. We'll speak to Elyas Galou of Bank of America on a less pessimistic global fund manager survey, and Skylar Montgomery-Koning of Barclays as US-EU trade tensions continue to simmer. We begin this hour with our top story. President Donald Trump kicking off his Middle East trip in Riyadh. Joining us now from the Saudi capital is Bloomberg's Annmarie Hordern. Annmarie, welcome back to the program. We've missed you. Let's talk about the meeting taking place right now with the President of the United States, Donald Trump, the Crown Prince, Mohammed bin Salman, meeting with a bunch of business leaders in Saudi Arabia. What's the objective of this trip?
I think it signifies exactly what this administration is trying to achieve with making Riyadh their first foreign official state visit, as the president did in 2017. No surprise to anyone who's been watching the tea leaves of this administration and where they see the gravitational pull as we are now entering in this post-war paradigm, not going to traditional allies, doubling down once again on the Gulf. The president, when he became the 47th president after inauguration, his first call was to Crown Prince Mohammed bin Salman. And on that call, the Crown Prince said that they would offer up $600 billion in investments. The president has joked he actually wants to see it to $1 trillion. The key question, as you hear all these deals be announced, is will that actually come to fruition? But who's in the room gives you really a telltale of what sectors to look out for. You, of course, have Elon Musk. You have OpenAI's Sam Altman. I saw him greeting as well Dina Powell, an individual who has worked as well in the government, now in the public sector. Andy Jassy of Amazon is here. Boeing CEO is here. These are the kind of deals you can see. Things when it comes to aircraft, defense, and key among them, semiconductors, as also the president will be making his way to the Emirates after Riyadh, where they already committed $1.4 trillion. To do that, though, they say they need access to advanced technologies, those high-tech chips, which is why someone like Jensen Huang in the room is critical for this administration and for the Gulf.
Annmarie, this trip comes at a time that is highly fraught, not only from a geopolitical stance, from a trade stance, and then, of course, from an economic stance, which is clearly the focus in these discussions. Can you give us a sense of what people are expecting on the geopolitical front, especially given the key region's position when it comes to both Russia, Ukraine, as well as Gaza, Israel?
Well, I think all roads really lead to the Middle East for this administration. They see the Middle East as a place not just for financial deals, which we just discussed, but also as a place to mediate geopolitical tensions. When it comes to a place like Riyadh, there has been tons of meetings already in the kingdom's capital when it comes to trying to negotiate an end agreement, a peace negotiation between Russia and Ukraine. We should also note on this trip, the president, as of planned, is starting here, and then he's going to Doha, and then he's going to Abu Dhabi. But before he left the White House, he said maybe he'd make a stop in Turkey. Why? Because in Turkey, you are going to have Ukrainians and Russians come together, potentially to discuss some sort of ceasefire agreement. But the president sees the Middle East being the broker of all of these geopolitical conflicts, most notably Ukraine, but also what is going on right now in Gaza, as well as, of course, this is a region that they're trying to bring closer to Washington to make sure that they can combat Beijing.
Annmarie, appreciate the update. Stay close. Annmarie on the ground in Riyadh, Saudi Arabia, expecting several deals to be announced, several investment commitments to be announced over the coming days. When we get those headlines, we'll bring them to you. Equity futures at the moment negative by 1/3 following a major move yesterday. Here's the view from Wall Street this morning. Tchir of Academy Securities writing, it does seem that the president is back to viewing stocks as an up-to-date measure of his policies and that he wants to see the market higher because it means he's winning. Pete joins us now for more. Pete, good morning.
Good morning.
What does winning look like?
I think it seems to be all about Wall Street again. We went about 2 weeks of it's all about Main Street versus Wall Street, and it seems like he has very much reacted to the stock market. So, we could go down a bit from here, but I do feel like there is a Trump put again at this point.
Well, we've had a major rally. We're up by 3% since April 2nd. We're up by close to 20% from the lows of mid-April. I mentioned at the start of the programme, the market is viewing this as a one-off event, totally recoverable, limited scouring. Do you see it the same way?
No, I feel probably a little bit more worse than that. I feel like we're back to where we were maybe a couple months ago in terms of tariffs and things like that, or at least what was being discussed, except we've annoyed the rest of the world, and it looks like unilaterally we've backed down. So I think if other countries were a little bit worried, well, is there this 4D chess going on? Is there something that we don't quite understand? Maybe they're not so worried about that as these negotiations occur. So I think we will get more deals, sure. But I think every country is now trying to figure out how do they reduce their exposure to Trump going forward or the U.S. going forward. And ironically, we kind of let China off the hook. I think if you were thinking about how to distance yourself from the U.S., China, you were maybe a little bit leery because, they're at 145%. They're right down to 30%, headed towards 10%. China's back on the table. It all seems very strange to me, and I think we've lost. It will probably take some time for that to play out.
Well, I see two responses on Wall Street. On one hand, you've got the David Costins of Goldman Sachs of the world upgrading their year-end forecast for the S&P 500. On the other hand, you've got Mark Heffley over at UBS coming out and actually cutting U.S. stocks to neutral from attractive, saying, where is the upside? Which do you agree with more? It sounds like more Mark Heffley.
I think more Mark. You look at it, we're getting back to February type levels. We're starting to approach the highs, and I don't think the situation's as good as it was back then. I think we have alienated ourselves with some of the rest of the world. Yes, we're so big, so important, people are going to have to trade with us, but I don't think there's going to be that same vibrant demand globally. I think domestically, companies are going to be a little bit slower to react. There's been too much volatility, so I think you see some slowdowns there. A lot will depend on whether we can get back on track with, build, baby, build, or whatever you want to call it. We've always kind of viewed it as anything for national security should be produced domestically. We did think that meant with our close allies. Maybe that's too broad right now. If we get back on track on that, then I can see the growth story, right? That's less adversarial with the rest of the world. We can spend our money. We can go through that. So I'll be tracking the budget and kind of whether we're getting deregulation. That, to me, is where the upside comes from, not the tariff.
It's maybe not a coincidence. Treasury Secretary Scott Bessent has talked a lot about the three-legged stool and the fact that deregulation and the budget plans have to come along with the tariffs. It's no coincidence we are getting this draft of the budget. What's your first take on that in terms of how much that does provide a floor to valuations and potentially upside?
Well, I guess my second take would be that we should have started with this process instead of how we did it. I think that would have made a big difference because I do think some damage has been done. We'll be watching this again. Has the party, lost some support internally, right? There's got to be some questions about how it's all gone. So I'm not sure that it's going to be smooth sailing. I hope it is. And then, again, we keep talking about wanting to bring jobs back to America. Presidents in Saudi Arabia, yes, they're going to invest in the U.S. Saudi Arabia wants to become the data center capital of the world, right? I don't think we should be worrying about losing, factory works. We should be worried about losing jobs to the data centers. And Saudi's well positioned. They've got the energy, both for the, traditional energy, fossil fuels, but they're building out solar. They are an ideal place to do data centers in many ways. So yes, that's great, but those are the businesses I think we should be really trying to protect and do domestically.
Speaking of data, we get data this morning, 8:30 Eastern Time, CPI, onto Thursday retail sales. Lisa mentioned Max Kettner. Max Kettner thinks the data situation now is win-win. If it's weak, people will ignore it. They'll say this was the pre-tariff China negotiation world, the old world, and if it's good, they'll embrace it. How will you treat the incoming data?
I'm kind of ignoring most of the incoming data. I think it's so hard to tell where we're going to wind up as a steady state. And now with the new tariffs coming back, on China, I assume there's going to be a huge rush of orders again, right? If you're sitting there, oh, well, now we got a reprieve. It's at least 90 days. Let's bring as much stuff in as possible. There were signs that shipping was kind of picking up from China already. So maybe some people already had an inkling or the wink, wink, nod, nod. This is going to get better. Maybe they just guess better than other people. But I think you're going to have this another wave of imports coming in. That means jobs don't get cut. I think it's really hard to get a true economic read.
What's on your dashboard then? If it's not the economic data, what is?
Twitter trying to figure out what Trump is going to say next.
Is that what it comes down to?
I think to some extent you're trying to figure out where are we back. And I always go back to Trump, and I think, his goal is ultimately to rebuild the middle class of America. And he thinks there's two things that have to be done to do that. One, you have to get manufacturing back here. Two, you have to reduce the deficit. I didn't think the approach on tariffs was going to accomplish those goals. We've backed off. So now I'm looking, what is he going to do to get those goals back? And I do think if he can pivot, and he's been very good at it, right? He made some policy decisions that I thought were very questionable, certainly Wall Street thought were questionable. He's stepped back from that, right? He's walked that back, and now I think we pivot, and that's where, to me, the upside is going to come from, do we see deregulation? Do we see government funding and subsidies to grow our domestic industry? And again, some of these things are going to be competing with China, but it's more implicit rather than the explicit trade war. So that's what I'm looking for is, where do we head there? Do we see that? And then at the same time, I'm going to be looking, what noise is going to be unexpected? Does he decide to say something about the debt ceiling that spooks markets? So I think every time we're Trump, and when it looks too good to be true, get nervous. When it looks too bad to be true, get positive.
The decades of experience on Wall Street, the postgraduate degrees, the PhDs, the CFAs, and it comes down to following the social media account of one person.
The rubber hammer on your knee, as we heard about yesterday, essentially the headlines that are going to make your knee just kick up your leg and then maybe come back down again. Is this really what it's come down to? If the dashboard, as you put it, John, is basically comprised of information that's dated and probably too messy to use?
Pete, we'll talk about taxes and the bond market in just a moment. Peter Tchir of Academy Securities is going to stick with us. If you're just joining us, welcome to the programme. Following yesterday's big rally, the equity market just a little bit softer this morning. We're down by 1/3%. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Arnott. Hey, Yahara.
Hi, John. President Donald Trump has arrived in Saudi Arabia for a 4-day tour of the Middle East. He was personally greeted by Crown Prince Mohammed bin Salman. Meanwhile, Treasury Secretary Scott Bessent is also in Saudi Arabia, where he told an investment conference he's upbeat on trade talks with countries in Asia, but believes progress with Europe will be slower. In Washington, House Republicans unveiled details of their long-awaited tax package. The draft bill includes many of President Trump's campaign pledges, including no taxes on tips and overtime pay. It also makes permanent the lower individual tax rates Trump signed in 2017. It does not, however, include a tax hike on the wealthiest Americans. And shares of Nissan rose in Japan today, the company vowing to close 7 factories and cut 20,000 jobs as part of a restructuring plan aimed at cutting costs amid weak sales. The car maker also said it will withhold its annual profit guidance due to fallout from President Trump's trade war. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the programme, Trump's tax bill.
We will make the 2017 Tax Cuts and Jobs Act permanent. We will add more features that are very friendly to capital. I believe that we will have it passed this summer.
Up next on the programme, we'll get you an update from Capitol Hill. We'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Big rally to kick off the trading week this morning, just a touch lower. We're down on the S&P. We're negative by 1/3% following a 3% rally yesterday on the S&P 500. A 4% move on the Nasdaq 100. As Lisa mentioned, David Kostin at Goldman Sachs, new forecast 12 months out, 6,500, up from 6,200. Under surveillance this morning, Trump's tax bill.
We will make the 2017 Tax Cuts and Jobs Act permanent. We will add more features that are very friendly to capital. We're going to bring back 100% expensing. If you build a factory in the U.S., you can expense it immediately. I believe that we will have it passed this summer.
So here's the latest this morning. Republicans unveiling a draft tax bill filled with President Trump's campaign promises, including raising the SALT deduction limit, eliminating taxes on tips and overtime pay, and new tax breaks for car buyers and for seniors too. Joining us now in the nation's capital, Bloomberg's Tyler Kendall. Tyler, that bill is packed with stuff the president wanted. How much support does it have on Capitol Hill?
Yeah, hey, John, good morning. Well, it depends who you ask and which provisions you're talking about, because it is rather wide-ranging, and there are some still really big sticking points here. Of course, it does some widely popular things. You named some of them there. Making permanent the 2017 tax cuts, no taxes on tips, overtime pay, didn't end taxes on Social Security, but does give our seniors a $4,000 bonus. But at the same time, some of those sticking points include raising that SALT cap, which we know, as of now, that $30,000 proposal isn't going to be enough for Republicans from these high tax states. Now, there's going to be a conversation going forward here about how exactly House Speaker Mike Johnson is going to thread this needle, because at the end of the day, he can only afford to lose 3 Republicans if he's going to make this reconciliation process work, which means that they're not going to court any Democratic votes. So today there's going to be 2 really big committee markups. It's really going to feel like we are kickstarting a race to Memorial Day. In one committee, it's going to be the tax cuts. In the other committee, it's going to be the spending cuts. And that's really where we're going to be watching, since we know that fiscal hawks on Capitol Hill want to see some deeper pledges to get spending cuts up.
Tyler, which is the more controversial aspect within the Republican House? Is it the spending cuts when it comes to Medicare and Medicaid, as well as some of the other potential ways to bring down the deficit? Or is it the spending and the inability to raise the SALT cap even more?
Right. Well, they kind of go hand in hand at this point, Lisa, and that's because Republicans do want to help President Trump when it comes to his tax cut priorities. But at the same time, they say that they really do need to see some of these firmer pay-fors come forward. And to be sure, this tax bill in its current iteration does include some revenue-raising provisions, including hiking taxes when it comes to private foundations and endowments of private universities. Also rolls back, for example, some of those IRA tax cut tax credit provisions when it comes to clean energy technology and electric vehicles. But even with that, we saw some House Freedom Caucus members already come out saying that they don't want to see a slow repeal. They want to see them immediately eliminated. So it's really starting to get into the weeds here. And even when it does come to those Medicaid cuts, while there's sort of been a compromise here, we're likely going to see work requirements added to them for people up to the age of 64. At the same time, Republicans in the Senate are starting to raise their voices, including Senator Josh Hawley. One Congressional Budget Office analysis, Lisa, predicts that 13.7 million people could lose benefits through 2034 if the current Medicaid proposal goes through.
This is going to be tough, and it's a pretty aggressive timeline as well for this tax bill. Tyler, thank you. Tyler Kendall down in Washington, D.C. Peter Tchir of Academy still with us. Pete, let's go through this. Raising the SALT deduction limit, eliminating taxes on tips and overtime pay, new tax breaks for car buyers, for seniors. What's the biggest obstacle to this bill? House Republicans or the bond market?
I think it could be the bond market, though right now I think everything seems pretty calm. Like this came out, the bond market's reacting reasonably well. I do think reduced tariffs gives Pyle a little bit of ammunition if he has to cut rates to do that. I think this is all kind of working relatively smoothly. We'll see where this all comes out. I have to say I don't personally understand no tax on overtime, because I'll just sign up for 5-hour work weeks and go on from there.
I'm planning to do the same.
So it'll be really interesting to see how this gets through, where the pushback is. I think, at a bare minimum, you got to get the exemptions, the extension through, but that's not really a tax cut, right? Keeping that is just the status quo. So you have to get some of these other things in to really get the growth. So that's what I'll be watching quickly.
You mentioned Chairman Powell. Let's talk about the Fed just briefly. Yesterday, this move by the US and China unlocked higher bond yields At the front end of the curve, there was a view that this reduced recession risk and pushed back rate cut bets of the Federal Reserve. Would you push the other way?
Yeah, I would push the other way. I think for the first time in a little while that the bond market's not pricing in enough cuts. I think we should still get 3 to 4 this year. I think they come sooner. Yes, we might get some inflation from the tariffs, but I think they can look through that a little bit more clearly. And we have seen some deflation, right? We've seen, goods coming down. I think the U.S. consumer is a little bit slower than maybe expected. I think companies are going to spend a little bit less. I do think there's going to be problems with growth in terms of getting sales done in Europe. So I think the Fed's going to be in a good position to cut a few more times. That could appease Trump, because really what was holding them back, you can't cut when there's 145% tariffs where no one knows where they're going to go in the globe right now. At worst case, you have 10% is kind of the worst, 30% is the best, I guess. You move from there. I think Powell is actually going to be able to cut come June or July.
There are two ways of looking at this. One, that the scarring is much more intense than people previously expected when it comes to the economic damage from the tariffs that were announced on April 2nd. The second, that this is the good kind of rate cuts. This is the kind of rate cuts that can happen with disinflation, even though we're not going into recession. Which is it?
Right. I think it's the good kind of rate cuts that, just like we saw late last year, he was comfortable that despite Jaws being good, inflation was coming down enough that he could cut a little bit. So that's what I'm looking for. It's not going to be a panic cut. I think recession's still a risk this year. It's reduced. I think it's more heading down to a slowdown, but that will give Powell the ammunition to cut. I think 440, 445 on 10s, that's a buy. I think around 410, 415, you don't want to own them. And then you watch quickly, what happens with all the negotiations, and do we completely lose any fiscal stimulus or fiscal responsibility or not?
This feels like a choose your own adventure. You've gotten to this path. Choose path one, choose path two. It feels like, let's say the Fed does cut rates and it's a good kind of rate cuts. There's a theory out there on one hand that is that could juice growth enough to keep inflation higher for longer, which actually raises the yields on the long end. And then on the flip side is this idea that actually if you've got faster growth, that allows this government to actually acquire more debt, because then the debt to GDP looks more sustainable. So which do you choose?
I think it's really hard. I think you will see steeper curves, because I think if you do get the cuts, a lot will be issued at the longer end to try and capture that, right? I think the one thing we've talked about for years is it's insane to me that the American public figured out how to lock in rates during ZIRP. American corporations figured out how to lock in long-term rates during ZIRP. The only thing that didn't do it was the U.S. government. It's something I think Best and them are having to deal with. It's probably very frustrating to them. You look at our balance sheet, and we kept shrinking it to front end to save a little bit of money when we could have locked in 30, 50, there was even talk 100-year bonds. We did not do that. So I think Besant will try and get the shape of the yield curve looking a little bit, not the shape of the yield curve, but our issuance and our debt profile locking in and taking advantage of any drops in rates.
To be fair, if the Treasury had extended the average maturity, how much space would there have been for everybody else?
Fair point. Spreads might have been a little bit wider. Things were so cheap, I think things could have got done. I think they could have crowded that a little bit. There was so much demand from insurance companies and pension funds. And that's going to be, I think, the big thing we're going to have to watch for the coming weeks and months is I don't think we're going to see this resurgence to buy America. We might see some of it in the stock market, where I think people see, okay, the upside's here in the stock. I think in the bond market, countries, and it's not so much the central banks, it's going to be the pension funds. Those are going to continue to invest more and more domestically, I think, in the bond market. So I think our yields are not going to get that great support. That's why I see kind of 410 as a floor, even if things go well on 10s.
Close to 450. Good to see you. As always, Pete, thanks for dropping by. Peter Tchir there of Academy Securities. In the equity market at the moment, we are just a little bit softer. We're down by 1/3% on the S&P. In the bond market, yields come back in, Lisa, after a big move higher across the curve yesterday. 2s out to 30s.
Yeah, what's really fascinating to me is, as you pointed out, John, this idea that the front end, so the bulk of the selling, this was a repricing of downside risk and the Fed's response to it. The debate now is going to be, is there a less of a reason for the Fed to cut, or is there just as much of a reason, it's going to be the good kind of cuts and not necessarily the ones that come on the heels of recession?
A bit of pushback to the consensus view from Pete just moments ago. Up next on the programme, Elyas Galou of Bank of America on a less bearish global fund manager survey. Got some big moves to forecast on China just dropping on GDP. Goldman Sachs going to 4.6%. JPMorgan lifting their forecast for GDP growth in China from 4.1% to 4.8%. Just like that, off the back of the trade truce over the weekend. And just like that, this equity market is in a very different place this morning. Equity futures slightly negative this morning, down by 1/3%. But this follows a blowout rally on the S&P 500, taking the gains from the lows of April on April 8th at the close to more than 17%, a 17% rally in about a month on the S&P 500. 3 hours away from the cash open this morning. Let's get you some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Also to the downside this morning, Constellation Energy taking a hit after the big, beautiful bill coming out of Washington, D.C., the draft of which showing that the administration would pay for some of it by phasing out clean energy tax credits. Clean energy tax credits that producers like Constellation had benefited from. Now, it's off some of the lows, maybe the worst of the phasing out, the most aggressive of what was feared wasn't in that bill, but nonetheless, shares are falling in the pre-market. To the upside this morning, Coinbase, a big old rally for them, up nearly 9.5%. This is very mechanical. It's going to be added to the S&P 500. S&P Dow Jones announced the rebalancing of which yesterday. It's going to take the place of Discover Financial. It's always very important for companies because a lot of passive money flows into these indices. So that's why you get the rebalancing as different funds start to try to readjust to incorporate that. Now, finally, another stock moving to the downside this morning is Pinterest. A report from the information overnight that Google, at their annual developers conference next week, is going to unveil something that looks literally like a Pinterest, at least a very close direct competitor, something that you can look at photos of fashion inspiration, DIY projects. You can save them all into a folder. Again, sounds a lot like Pinterest. So those shares down about 3.33%, John.
Danny Berger, thank you. More from Danny in the next hour on some of the movers to watch for this morning. On our radar this morning, our top story, President Trump arriving in Saudi Arabia, kicking off his first major overseas trip since taking office. Trump hoping to secure as much as $1 trillion of investment commitments.
And as Annmarie was talking about, it's really notable who's there alongside him. Not only Jensen Huang, but also BlackRock's Larry Fink, Citigroup's Jane Fraser, Palantir's Alex Karp. I mean, there's this huge investment symposium of major U.S. business leaders. The focus squarely on investment. This is the catch, though. Saudi Arabia is looking to diversify its economy away from just the energy space. So they do want to invest in something new. The key is going to be these chips, and that is going to be very much the focus, which we're already hearing something about.
And the curbs to them. It's almost like the unwritten deal between the two sides at the moment. You've seen crude crash off the back of this increase in OPEC plus output driven by Saudi Arabia. Now, you can pick your poison as to why that's happened. Some people think it's happened because of this very trip. And the president's got to fulfill his end of the bargain now. Get that access to those chips.
That is very well framed. Should that be what exactly happened? Was that there was an increase in output, that lowered oil prices, and now the other side is coming to the table? Look, there is going to be something agreed upon with chips. We are hearing that reporting coming out early this morning. It seems like it's even bigger than that, because there's a geopolitical element to this. It's coming at a pretty prominent time where suddenly there are deals being had in parts of the world, whether it's Iran or whether it's Israel and Gaza. And so you start to wonder, what is the whole picture here that we're going to see that's going to sort of come out of the woodwork in a week's time?
It is notable where the president is. It is more notable where he isn't. He is not in Europe, with no plans to go there anytime soon to talk about a trade deal. The US Treasury Secretary Scott Bessent downplaying the possibility of a quick trade agreement with the EU.
Europe may have a collective action problem, that the Italians want something that's different than the French, but I'm sure at the end of the day, we will reach a satisfactory conclusion.
The words of the Treasury Secretary Scott Bessent just there this morning. Yesterday, the words of the President of the United States. The EU in many ways is nastier than China.
Yeah, and he'll say, oh, they'll come down a lot. You watch. We have all the cards. They treat us very unfairly. These gripes, as we heard from Peter Navarro, have to do with the VAT tax, which is something that cannot easily be changed and is not necessarily under the same rubric in any way, shape, or form as a levy, as one of these tariffs. There's a real question here of whether you can get Italy on board with Portugal, on board with Spain, on board with Germany and France. There is a real sort of divergence of goals, and that is going to make it very difficult for this kind of collective bargaining, as Scott Bessent notified.
Totally agree with you. Multiple ways of looking at this situation. Here's two. One, you can look at the agreements of the last week or so with the UK and China as a template, a sign maybe that things are easing and it's a good time to get a deal with the United States. There's another way of looking at all of this. The administration's got to make an example of someone, and if it's not China, is it Europe?
That's what a lot of people are pointing to. This is going to be a lot more difficult. But at what cost, right? I mean, for Europe in particular, and this actually speaks to this huge Buy Europe trade. How much do they get inundated by Chinese goods as well as potentially a barrier from the United States? It's sort of a double whammy at the same time that they're trying to prop up their economy with fiscal stimulus.
Watch this space. For the Europeans, watch this space. Watch this space, a rather large space. House Republicans releasing a draft version of the tax bill. The multi-trillion-dollar package includes raising the SALT limit to $30,000, no tax on tips, tax breaks for car buyers and seniors. And Republicans are aiming to pass all of this by Memorial Day. We asked Peter Tchir, biggest obstacle to this, House Republicans or this bond market?
And frankly, the bond market is a lot scarier than House Republicans because you can whip them into shape, so to speak, when it comes to offering other sweeteners. Does the bond market start to respond to the fact that because of the reluctance to make some of the cuts, in particular to Medicare, there is going to be an increase to the deficit to the tune of some $5 trillion over the next decade? That's according to the Committee for Responsible Federal Budget. So you start looking at that and you wonder, OK, how do we price in the growth rate, especially with higher tariffs, and then understand just how much more of a premium there should be in the Treasury market? We'll have to see. Peter Tchir, though, went on to say he doesn't see it necessarily coming into a surge in long-end Treasury yields. We'll see. It depends on the inflation print, and that's the reason why it's important to watch the data, which everyone will dismiss as irrelevant.
Ignore the data if it's bad and embrace it if it's good.
I guess.
Seems to be the approach. Win-win, I'm told.
I think it's getting increasingly complicated, but I like the sort of simplicity of win-win.
Equity futures at the moment, negative this morning by not much. We're down by a third of 1% on the S&P. Let's talk about investor sentiment. Bank of America out with its May Global Fund Manager Survey showing Wall Street slightly less skittish ahead of US-China trade talks this past weekend. The outlook, an improvement over uber-bearish April as investors say recession is less likely and soft landing returns as a consensus outlook. Joining us now, Elyas Galou of Bank of America. Elyas, welcome back to the programme, sir. Let's talk about how much things have changed. And please share with us, when was this survey conducted and how much does it capture the talks over the weekend?
Hi, John. I think, the context this month is particularly important because, indeed, the survey took place between May 2nd and May 8th, hence before the big announcements that were made yesterday. But it's important also to note that 75% of FMS participants shared their view even before the announcement of conversations between the US and China trade representative in Geneva over the weekend. Hence, this explains really the bearish tilt that you can still see in this month's survey.
You capture the mood pre-weekend then. And by capturing that mood, you also capture this positioning. Investors the most underweight the dollar since May 2006. Gold the most overvalued in 20 years. So given what we know now, do you think there's space still to lean against some of that positioning?
I think it still matters a lot because, in fact, when we had seen the results of the survey yesterday, we were really, in my team, we were really understanding the market reaction. It all made sense because of positioning, because of that the sentiment that was really gloomy when it comes to U.S. assets in particular. You said it, the most bearish underweight U.S. dollar since May 06. Also, very bearish positioning when it comes to U.S. equities, biggest underweight since May 2023, and also when you look at global macro expectations, they improved from the very bearish level of April, but still on an absolute basis they remain pretty much very bearish, and hence it explains that in fact at the moment still the pain trade based on positioning and sentiment is still up in the very near term.
So, Elyas, I want to build on that. You also say, though, that most of the gains are now behind us. So even though the pain trade is up, it seems less clear how we get that pain trade given some of what we've seen over the past few days. Can you explain?
Yeah, sure, because if you just look at the absolute positioning, investors are very much underweight risk. You still see a big underweight when it comes to global equities, and this big underweight is particularly acute when it comes to U.S. equities, which make up still 65% of the global equity market. And the biggest sector of all, the tech sector, this engine of global EPS growth, investors were very big underweight. They had a very big underweight on the tech sector last last month. They hiked their exposure to the tech sector by the most in 12 years. But still, in May, they are neutral, the tech sector. So you see that despite the nice improvement that we saw over the past couple of weeks, investors remain underweight risk, and this is why we say that most of the gains are behind us, because it still is very hard for the S&P to reach new highs, for the Nasdaq to reach new highs when we face this kind of dislocation in global trade, and where there are still pretty much paramount downside risk regarding global growth.
Elyas, we were just speaking with Peter Tchir, where he asked in his note, was it all a bad dream? And a lot of people have asked the same question, and with different answers, though a lot of people seem to say, no, it wasn't. And there have been some structural changes that are going to remain in place. I'm just curious what you think of some of the changes we've seen with respect to Buy Europe, Sell America when it comes to treasuries, whether some of what we've seen with just general aversion to dollar-denominated assets will stay in place, or whether that's going to revert back to where it was before April 2nd all took place.
I think, Lisa, in order to answer your question, you either need to focus on the short term or the longer term, which is defined by the bigger picture. In the short term, positioning drives risk assets. It explains the move in risk asset. In the short term, clearly, the big rotation out of US into Europe explains why over the next few weeks, there is a strong likelihood that US assets will outperform European assets or rest of the world assets, in particular when it comes to the most oversold part of the US stock market and the US dollar. But if you still look at the bigger picture, you still see the biggest dislocation in global trade since the early 1930s and the Great Depression. You still see a big dislocation in the world order as we've known it since World War II. And this brings long-term structural changes, which takes quite a bit of time. But the decisive move is in favor of international assets, and that's what we see in terms of the flows. For every $100 of outflow out of European equity funds since the war in Eastern Europe in 2022, only $16 have flown back into European equity funds. You see here the huge catch-up potential ahead of us.
Elyas, let's just finish on that, the international story. We saw some upgrades to Chinese GDP this morning. Goldman went to 4.6%, JPMorgan moved to 4.8%. Based on the truce over the weekend, who do you think it helps more, the US or China?
Clearly, in the short terms, it does help the US because you remove off the table the biggest downside risk out there, and it explains also why we've seen this biggest rotation back in favor of the US. But over the longer term, it clearly helps international markets and China in particular, because it also will support the mood in favor of this rotation into international, which is a theme we've been advocating on for quite a while.
Elyas, appreciate your time, as always, and the update. Elyas Galou there of Bank of America on their latest fund manager survey, the highlights of which read as follows. Investors the most underweight the US dollar since May 2006, and gold the most overvalued in 20 years. And we saw some of that unwind in a big way in yesterday's session.
And it shows why there was this knee-jerk unwind because of that positioning, and why it was immediately into the dollar, why it was against gold, why it was into U.S. risk assets. Question is how sustainable it is. And you ask the right questions about who benefits the most from some of these trade deals. I would argue how much of that international flow gets accelerated and how hairy does it get when it comes to Europe, given what we just talked about.
Gold down yesterday by 2.6%, up this morning by about 0.5%. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. United Health shares are falling 8% in the pre-market. The company announcing a management shakeup. CEO Andrew Whitty is stepping down due to personal reasons. He will be replaced by Stephen Hemsley. The company also suspending its outlook, saying medical expenditures are expected to be higher than anticipated. It expects a return to growth in 2026. Meanwhile, President Donald Trump was greeted by Crown Prince Mohammed bin Salman when he arrived in Saudi Arabia today. The two will soon have lunch at the Saudi royal court. A large U.S. delegation will join the president at the lunch, including members of his cabinet, as well as chief executives from Amazon, Citi, Boeing, IBM, and more. And President Trump says he won't use a luxury jet being offered by the Qatari government after leaving office. The announcement comes amid criticism over his administration's consideration of using the plane as the next Air Force One. Trump says the luxury Boeing 747-8 jumbo jet is a gift to the U.S. Defense Department and not to him personally. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in the next hour. Up next on the programme, the EU in the crosshairs.
Trade to European Union is in many ways nastier than China. They'll come down a lot. You watch. We have all the cards.
That conversation up next with Skylar Montgomery-Koning of Barclays. Live from New York, you're watching Bloomberg TV. Trade truce between the US and China driving a gain of more than 3% on the S&P 500 in yesterday's session. This morning, pulling back just an inch. We're down by 0.2% on the S&P. Under surveillance this morning, the EU in the crosshairs.
The European Union, they were the toughest of all. They were nasty. And I see that. I see that with trade too. European Union is in many ways nastier than China. Okay? And we've just started with them. Oh, they'll come down a lot. You watch. We have all the cards.
It's the latest this morning. Tensions remaining high between the US and the EU, with Treasury Secretary Scott Bessent downplaying the chances of a quick agreement. Bloomberg's Ollie Crook joins us now from Brussels. Ollie, that language there, the European Union in many ways nastier than China. The President of the United States. How's Europe responding?
Yeah, I think that for the Europeans, despite all the sort of issues that exist within trade and an acknowledgement that they're willing to make some changes in terms of the balance of the relationship, I think the most regrettable thing as far as the Europeans are concerned has been the tone, both from, J.D. Vance and his early trip to Munich back in February. But again, these repeated sort of insults to the European Union from the Trump administration, basically saying that they're worse than sort of some of the greatest adversaries of the United States. And then Scott Bessent, again today, sort of highlighting this idea that the Europeans have a collective action problem. I mean, that's sort of the European Union's middle name. They are not great at collective action, but they don't also operate fundamentally like the United States of America. We're talking about a consortium of 27 different sovereign nations, and the issue that they are having in these negotiations with the Trump administration is this massive cross-pollination and cross-contamination of different issues with trade, with tax, with regulation, all of these sorts of things that the Trump administration wants to seem to address within the European Union that, frankly, the European Commission does not have the power to negotiate with and to change. They can negotiate on trade. They don't have the power to speak on behalf of 27 nations on VAT, on regulating the tech companies and all of those sorts of things. And those comments themselves coming from the Trump administration, from Donald Trump, was at a press conference about lowering drug prices in the United States in order to raise them in Europe. So again, for the Europeans, they're very detail-oriented, they're very process-oriented, and they're finding this negotiation very, very challenging right now. And they've made very, very little progress, to the point that we've heard it from Scott Bessent and from Donald Trump, that they're falling further and further behind in terms of actually achieving a deal with the United States.
Stuck between a rock and a hard place. Ollie Crook with the update out of Brussels. Ollie, thank you, sir. To extend the conversation with us now, Skylar Montgomery-Koning of Barclays. Skylar, good morning to you.
Good morning.
Euro-dollar this morning, 111. Yesterday, the biggest one-day move lower since the day after the election. Good news for the dollar. How bad is the bad news for the Europeans?
Yes, well, this is the issue, right? The euro has largely been trading as a liquid alternative to the dollar. And so yesterday it saw a lot of downside because it saw a lot of upside when the dollar was under pressure as well. I think for the euro itself, the domestic outlook isn't great. From a growth perspective, you're balancing tariffs versus fiscal policy. Right now, tariffs are more growth negatives, and the fiscal we've had so far is positive. So you need another kind of boost there before you can get more positive on the euro. And I think the other issue is, as the price segment before alluded to, it's really hard to get a trade deal with Europe because you're negotiating with a number of countries, but you also have these non-tariff trade barriers that make it very hard. And you saw that even with the US-UK agreement. There wasn't a lot of detail there. It was just an outline. So it seems like that will be a headwind, certainly, for the euro going forward.
The trade wars in the past couple of weeks has been treated as more of a problem for the United States than the rest of the world, including Europe. Is this the tipping point where that discussion changes and you actually see more downside for the euro versus the dollar, because that narrative is going to flip on its head?
Yeah, I think it's something we certainly need to consider. Part of the story for the dollar was that you had this turn in the soft data that meant that you had Fed expectations reevaluated quite strongly, and that weighed on the dollar a lot. And so you could say to some extent, because you had that turn in consumer and corporate confidence, that fed into dollar weakness, whereas you've not had tariffs imposed on Europe for very long, so you haven't seen it feed into the data in the same way, and you haven't seen that corresponding weakness. So potentially there's more growth worries priced in the US than elsewhere. And I'll give you Canada as an example of what could happen, because Canada had tariffs imposed earlier. You saw that turn in confidence. That's turned into the hard data, and they've had a couple labor market reports that have been very weak as a result.
How much do rate differentials also start to matter again at a time where people are pricing in maybe fewer rate cuts by the Federal Reserve at the same time that the ECB might be prompted to cut more in the face of weakness?
Well, yeah, this is another reason that you should really have euro dollar be a lower level, because rate differentials tell you, and you can look at different points on the curve, but they tell you that euro dollar should be closer to 108 than where it is currently. And for us, we think those rate differentials should be more in favor of the dollar, even in terms of we think the Fed will be restrained by inflation. You won't have unemployment rise as you might have otherwise, because you have the supply side of the labor market constrained by immigration. And so that means we see the Fed cutting only twice this year. And in contrast, those other economies, because they don't get the price level adjustment of tariffs, they haven't retaliated. At the same time, they have lower oil prices, they've had a stronger currency, and there's likely going to be the supply glut from China. That means disinflation is more likely in these other places. And so for Europe, that means we see the ECB cutting towards 125, and that's a big gap to the US.
The damage done to the US dollar is multidimensional. It's not just about what's been happening with one thing, it's across several different dimensions. How repairable is that damage done with a simple truce between the US and China over the weekend?
Yeah, I think over the weekend, that was a big positive surprise for the U.S. because the expectation was tariff rates would be significantly higher than the levels we've gotten. And we've actually gone from an average effective tariff rate at the beginning of last week of 25% to 15%. So that's a big upside surprise for growth for the U.S. economy. At the same time, you've had the soft data turn, but the hard data is holding out quite well. And because of that, you could have a more supportive dollar environment. I think for us, fair value for euro dollar is somewhere closer to 107. You have that gap because there was somewhat of a risk premium priced in. But that risk premium, while it might be a little bit sticky, it can come off if you have more policies from the U.S. administration that seem practical or more pro-growth. And that means you could also have more flows into U.S. assets, especially if other assets aren't as attractive.
Dollar diversification, as you know, has been a conversation that predates the trade story. Yes. We've been seeing that diversification at the central bank level to gold now for a number of years. Is it enough to unwind some of that? Would you push back that far?
I mean, I think we'll see how it evolves. If it is truly an unwind story from dollar assets, then it can take a while to play out, and you might get kind of rounds of depreciation in the dollar as a result of it. But it's very hard to undo a decade of policy that's been very favorable for the U.S. And you're only seeing like little changes here and there at the margins, and the flows don't really support a broad unwind from the U.S. to elsewhere. The only place you really see it is in the COFR data, so in central bank reserves. Those have diversified away from the U.S., but it's been very slow. Over the last 5 years, it's been about 1% a year that you've seen diversify away. That was accelerated somewhat by the Russian invasion of Ukraine because it was shown that the U.S. could be used as a weapon. But since then, you've also had big cyclical upswings in the dollar. So it's not been a detriment in terms of the story of the dollar more broadly.
We keep going back to the same question that we were asking several weeks ago. Is this a negotiation or the new rules of the game that lead to a system-level shock? And it just feels like a lot of people now going with the former and certainly not the latter.
Talking about maybe this isn't a system-level shock where we ultimately have the same trading system that we had before, just with slightly higher tariffs.
Skylar, it's good to see you. Thanks for dropping by. Thank you. Up next on the programme, we'll catch up with Cara Murphy of Kestra Investment Management, Monica Guerra of Morgan Stanley, Chris Meekins of Raymond James and Mike Pyle of BlackRock.
There are so many angles to this tariff and non-tariff as we reconsider what this pause means.
The shock of the tariff announcements has clearly, weighed upon international investors.
We now have the market saying, well, maybe the growth outlook is not that bad.
The question is, how are the headlines going to progress from here?
It's certainly too early to declare all clear.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this on the S&P 500, erasing just a little bit of yesterday's big gain on the S&P 500. Yesterday up by more than 3%. This morning down by a third of 1%. Looking ahead to lots of economic data. It starts this morning at 8:30 Eastern Time. CPI this morning onto Thursday when we get retail sales. And this is the take on Wall Street at the moment. It's a chorus, a consensus. Stuart Kaiser of Citi, the data gets a free pass. Max Kettner of HSBC, it's a win-win situation. Lisa, if it's bad, ignore it. If it's good, embrace it.
How do you deal with data that gives you very little forward-looking information, that is going to be a mess and that people can use as a Rorschach test? Do they see some sort of bringing forward of demand, or do they see some sort of hesitation simply because of uncertainty that was delayed until later? The data itself is not necessarily going to tell much. This, I thought, was really interesting from Torsten Slok just moments ago. It takes time to rebuild trust. Maybe what we ought to be watching for the data is companies and how quickly they get back to investment, to hiring, and potentially to mergers and acquisitions.
I was just reading the same thing. The bottom line is that markets may recover quickly from this episode. It will likely take some time before confidence restored among consumers, corporates, and foreigners. You can move really quickly as an investor. Capital moves fast. You can't move quite as fast if you're moving physical goods in a company, and that's the issue these companies face.
You asked a question last hour. What do you have on your dashboard? And I've been thinking about it. And what do you put on that dashboard? And ultimately, you put on that dashboard bankers. Are they hearing about companies that are going to re-engage with M&A plans, with expansion plans? You talk to some of the people in hiring companies. Are they actually hearing about massive hiring plans? That might be the tea leaves to just how much this has been a bad dream and how much momentum is just starting to re-accelerate going forward.
You've got to know the rules of the game. And you've got to have confidence they won't change, not a week from now, a month from now. You've got to have confidence they won't change 5 years from now, 10 years from now. You've at least got to be able to make a best case assumption at this point. And I think still that's difficult to do.
Which is the reason why people are saying, what have we learned? Have we gotten something of a ceiling and a floor for what these tariffs might mean? Are we going to see that shipping boom, as we heard from Ryan Peterson over at Flexport? And how much does this really portend something longer term that can be a durable growth without inflationary pop that a lot of people are saying kind of on the margins is going to come, even though egg prices have really dropped quite a bit?
We've teased this out over the last 60 minutes, not egg prices, but the bigger theme. Will we look back on April 2nd as an event that's fully recoverable from, with limited scarring, or the start of a process? For certain investors, international investors, the start or maybe even the acceleration of a process to rethink the risks around US policy and what it means for how they allocate capital.
One key answer to that question will be the growth in the United States and just how much companies still have the lead when it comes to technological advancement, as well as just generally innovation. If the United States still has that, then people on balance will still want to invest here. If it is losing that, which is also part of the story, maybe then you could see that redistribution.
Big gains in yesterday's session. This morning, small losses. We're down by 0.25% on the S&P 500. Coming up, we'll catch up with Kara Murphy of Kestra Investment Management. As a big rally takes a little bit of a pause, we'll speak to Monica Guerra of Morgan Stanley with a tax fight brewing on Capitol Hill, and BlackRock's Mike Pyle on why the US economy is still looking healthy under the surface. We begin this hour with our top story. President Trump landing in Riyadh for his first scheduled foreign trip. Joining us now from the Saudi capital is Annmarie. Annmarie, let's get to it. The focus for you, deals, deals, deals. What kind of deals?
Absolutely. That's the focus for the President of the United States. And Jonathan, whether or not it's deals in the economic sector or deals when it comes to peace agreements, all roads lead to Riyadh for this administration. The president once again making Saudi his first official state visit, as he did in 2017. No surprise there. Mohammed bin Salman, the crown prince, was the first foreign leader he called after he was inaugurated and became the 47th president. What I am focused on, a number of sectors. One, we could potentially see defense deals. We know there's going to be a big Boeing jet deal when it comes to like of Qatar. And then specifically as well, when it comes to Saudi Arabia and the UAE, there are going to be deals when it comes to AI and advanced semiconductor chips. And it comes at a point when this administration decided to rescind the Biden-era diffusion rule, which put these geopolitical swing states capped on how many advanced chips they could buy, something we have seen Riyadh and Abu Dhabi really lobby for in Washington, D.C., and potentially they're going to get their wins today. And the president is going to get his wins when he goes back to Washington and says Saudi Arabia is willing to invest $600 billion, maybe the $1 trillion he asked for. UAE has committed $1.4 trillion. We should note these are big, big numbers for these countries, even though they have massive sovereign wealth funds. The key for the rest of the year and next year and the remainder of the Trump administration, how many of these deals actually come to fruition?
Annmarie, just build on that just briefly. The president got what he wanted. He got lower crude prices because the Saudis pushed for more production. Now, maybe you can say they were focused on something else. Other people think they were focused on precisely this. The ask is getting access to the chips. Can you be more specific on what that deal over chips might actually look like?
Absolutely. Mackenzie Hawkins, Matthew Martin just had a scoop out that actually moved the shares of NVIDIA and AMD. What Saudi Arabia will be asking for is access to those advanced technological chips. These are the chips that you're able to run those high-end AI models. Now, the key to this, for this White House, and really this is bipartisan how they feel in Washington, D.C., is to make sure that the tech does not leak to China. So potentially what you can have is a situation where it'll be housed here, these AI data centers on Saudi soil, but the access to that technology will be U.S. compliant and U.S. controlled. That is potentially a deal that we could see the president announce on this foreign trip.
Annmarie, stay close. Watch this space. Looking for that announcement potentially in the next 24 hours or so. Here's the view on Wall Street at the moment. This morning, Kara Murphy of Kestra Investment Management writes this. Noise around policy makes it harder to judge the health of the economy. Soft data is battling against hard data. The longer uncertainty goes on, the more it hurts that foundation. Kara joins us now for more. Kara, welcome to the programme. Let's talk about that spread then, the spread between the hard data and the soft data. Given the announcement over the weekend, yesterday to start the new trading week, how do you think that spread is going to move in the days to come?
Well, look, we've gotten some good news recently. And so I think the bifurcation that we saw between the soft data on the one hand, which was looking quite soft, and the hard data, which was still hanging in, that starts to narrow a bit. So I would expect to see things like confidence surveys start to improve going forward. And look, what we've had is like a narrowing of the range of policy outcomes when it comes to tariffs. It doesn't mean that we know exactly what certainty is going forward. So I think because of that uncertainty, we continue to have this sort of like lagging in soft data. But it will, you made this comment earlier, it's like reading tea leaves. It's going to be very complicated to be able to understand what the trajectory is over the next couple of months.
Kara, you point out that the particulars of the tariffs have never been the real problem. It's always been this uncertainty factor in markets that's been really hampering investment, et cetera. Now that we have a sense of what the ceiling and the floor is, maybe a narrower range of potential outcomes, does that give you more optimism to go into risk assets, to say that companies can make those convictions in terms of where to invest?
So I think from a market perspective, anything that lowers that amount of uncertainty is positive, and that's really driven this rally. And so as we think about the economic outcomes over, say, the next 12 months, we think stagflation is off the table, but that also doesn't mean that it's kind of off to the races in terms of economic growth. You have a lot of CEOs of companies that are thinking about making big capital allocation decisions that are going to have multi-year impacts. It's very difficult to make those types of decisions when you're in this uncertain environment. So we know that the tails are off, right? We're not going back to this environment where it's free trade at all costs. And we're also not in this super punitive environment where we essentially have trade embargoes on some of our closest trading partners. But there's still a wide range, right? And so a lot of companies are going to be very reluctant to make important multi-year decisions with that really wide range of outcomes still out there.
There's a big player in this, which has had the luxury of saying wait and see many times over and over again. That is the Federal Reserve, the Fed chair, that hasn't really committed to anything. Do you think that on the margins, this increases or decreases the chance that the Fed can cut rates for a good reason, because of disinflation and not necessarily because of some sort of recessionary impulse, thus giving, frankly, companies that confidence as well?
I think the Fed is still going to remain in this wait and see, period. Because again, this range of outcomes is really wide and there's no certainty that the next sort of deal is going to narrow that range of outcomes. There could be like some other big new surprise coming in economic policy. So I think as long as the Fed can wait, they will. If they start to see a significant deterioration in economic growth, then I think that will prompt them to action. But it feels to me like 2 cuts this year is about the right place to be. I think the market's getting a little bit too excited about more rate cuts than that.
Kara, some investors, though, are committed to just ignoring that bad data if we get some bad data in the coming months. Would you caution against doing that?
I would, unless we have that certainty, right? If we have a good sense that, whatever the tariff paradigm is going forward, then we can start to look through that near term, bad data, whatever it might be, whether it's inflationary or slower growth. But if there's still uncertainty on the other side of that bad data, it's very hard to sort of look through that. So I think we can, but we're not quite there yet.
So how do you want to use this period of market strength that's developed over the last several weeks?
So we had remained fairly, earlier this year, we had grown a little bit more cautious on risk assets, lowered our exposure to equities in favor of fixed income, also increased our exposure outside the US. And I think, I'm still comfortable being in risk assets going forward, but I want to be more diversified than just say the Mag 7 show that we've had over the last couple of years. So again, leaning into some of these non-US stocks, leaning into some other areas like value areas that have lagged over the last couple of years, I think that will really help to buoy portfolios into the second half of the year.
Kara, appreciate the update. Kara Murphy there of Kestra Investment Management. An update following a big trade truce between the US and China, leading some investors to believe you should ignore any data between now and maybe through the rest of the summer if the data is indeed bad. Now, we just got some pushback there, just a little bit of pushback from Kara.
Yeah, saying that you can actually take a look at it and that there is maybe something under the hood, especially if you get some level of certainty. Look, how many months has it been where the data has been completely unreliable? This has gone from a highly data-dependent market and Fed to one that thinks that it's totally fine to ignore the data. The truth is probably somewhere in between where the details actually probably do matter and that there is some sort of signal in there. It just gets harder than just saying, look at that headline number, buy or sell.
We had the front loading of imports hit GDP. We were waiting to see if this would hit payrolls in the coming month as well. And now the data gets a free pass. That's what Stuart Kaiser of Citi said overnight.
CPI, you have higher car prices in the used car markets, but egg prices have fallen off a cliff and oil prices are really low. Gas is getting cheaper and cheaper. So you get a free pass. I mean, sort of how do you gauge these things if you look at the if you look at the internals and you do see some ramifications, but you do see those offsets too. This is a complicated market and the data is going to reflect that.
Market wants to go up. Went up yesterday. Flying blind at the moment. 8:30 Eastern time. We'll get CPI data. Tiffany of Pimco will join us. David Kelly of JPMorgan Asset Management alongside her. Equity futures on the S&P this morning down about 0.25%. With an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. The Trump administration is preparing to announce a deal to grant Saudi Arabia more access to advanced semiconductors, allowing the country to increase its data center capacity. Sources telling our own Annmarie Hordern the agreement would boost the country's ability to buy chips from NVIDIA and AMD. The deal could be announced as soon as this week. Meanwhile, U.S. Treasury Secretary Scott Bessent says the European Union has a, quote, collective action problem that's slowing down its trade negotiations with the U.S. Bessent tempering expectations for a quick agreement with the EU, citing differences between member states like Italy and France. And China has removed a month-long ban on Boeing deliveries following the breakthrough in trade talks with the U.S. The lifting of the ban clears the way for deliveries to restart, but it's unclear how soon Chinese carriers can get the planes they need. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the programme, Trump's big, beautiful bill.
We will no longer be talking about tax cuts. Once this bill becomes permanent, this will be the law of the land for the U.S., and there will be great certainty on the tax side.
Up next on the programme, Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning. open about a few hours away. Going into that, equity futures just a touch lighter this morning, softer, negative by a few tenths of 1% on the S&P. On the Nasdaq 100, we're down by 0.14. Under surveillance this morning, Trump's big, beautiful bill.
We will no longer be talking about tax cuts. Once this bill becomes permanent, this will be the law of the land, because during President Trump's first term, what really generated the non-inflationary growth was a demand shock from the tax bill, and from that stimulus, it was met with a supply response from deregulation.
Here's the latest this morning. Republicans preparing to fight for President Trump's big, beautiful bill. A draft showing the GOP prioritizing Trump's campaign promises, including no taxes on tips and overtime pay, plus new tax breaks for car buyers and seniors. Tyler Kendall joins us now from Washington for more. Tyler, it might be easy to ask what wasn't in it.
Yeah, hey, John. Well, that's actually a pretty good question, since we were watching some of those key priorities, whether or not they would make it in. It does not include an increase for some of the most wealthy Americans making more than $2.5 million per year. Another thing that wasn't in it is that it does not repeal the tax break used by hedge funds and private equity industries that we had also been watching. But it does include some key priorities that we were expecting to be in there, or perhaps sort of snuck in under the radar. One of them includes factory incentives. The bill will allow a 100% depreciation for factories built under this term through 2029. That was something that actually was thrown on House Republicans sort of last minute in a bid by this administration to increase incentive when it comes to boosting domestic manufacturing, since we know that that corporate tax rate, lowering it, is not going to be included in here. At one point, you'll recall, on the campaign trail, the Trump campaign had floated lowering it down to 15% for companies that make their goods in the United States. At this point, that's not rolled up into this.
Tyler, just quickly here, where are the cuts? How much is this coming from Medicare cuts? How much is this cut, aside from the foundations and other tax cut breaks that have been removed?
So if we look at the math, the tax cut plan right now is pricing out about $3.7 trillion. The spending cut plan is pricing out about $1.5 trillion. So we are talking about deficit, adding to the deficit in this case. And that really is a big problem when it comes to these fiscal hawks who are pushing for some bigger pay-fors here, including when you look at some of those tax priorities that are still sort of in limbo, including that SALT cap, since we know that Republicans from high tax states have said that $30,000 isn't going to be enough. But of course, the higher that cap goes, the more money they're going to need to find when it comes to those offsets. Of course, the big focus has been on trimming Medicaid. And while we are expecting some work requirements to go into place here, they didn't include a per beneficiary cap on Medicaid spending, which was considering to be perhaps the more controversial and bigger proposal to get more of those spending cuts through. We're going to have to see how this shakes out, because it is a politically fraught issue, Lisa, particularly for Republicans. One database that we trust shows us that 37% of House Speaker Mike Johnson's constituents in Louisiana are on Medicaid, so any talks to slashing that number is going to be hard to push through.
Tyler, thank you. Tyler Kendall down in Washington with us now for more. Monica Guerra of Morgan Stanley. Monica, good morning. Good to see you.
Good morning.
Let's get to the congressional math, the numbers. How narrow, how tight are the margins in the House?
Very tight. They only have, just that 51% majority that could get this budget reconciliation bill through, which is why it's so important that, the SALT Republicans and the fiscal hawks, all come together and get a deal. This, I think, slows them down in their effort to get a bill to the president by that Memorial Day. We're thinking maybe they get it through committee by then, but we're already seeing those hiccups and things that are going to slow the pace of this. So we're still looking much further out into the summer.
You nailed it. Help me with the solution. How do you please SALT Republicans and the fiscal hawks simultaneously?
I think that's a really good question. I think it's going to be very hard to do. What you're likely to see is more movement on the tax revenue side. You can get some wiggle room on SALT if, say, for example, you put in caps on corporate SALT deductions, right, for example. So for those corporate spaces. Now, there's lots of other options that they could explore as far as raising taxes on the margins, like maybe addressing the carried interest loophole. So again, this is still early days. While we have a blueprint and we see where the priorities are, there's a lot of negotiation that still has to happen. And that's really exemplified by those two issues.
Which of some of the campaign promises from President Trump do you expect to have a harder time getting through to the final draft?
Yeah, so one of the things that we've talked a lot about is the no tax on Social Security benefits. This is a huge sort of campaign proposal that was bringing a lot of seniors to the table. That actually can't even be addressed in budget reconciliation because of the rules, or the parliamentarian rules around it. So we think that if something like that is going to come up, it's either going to be a 2026 campaign proposal or later in the year. Things like the no tax on tips, no tax on overtime, and now the seniors bonus are all on a temporary basis. So while we're getting a little bit of fulfillment on that campaign piece, it is still limited. And so that's important to just keep in mind.
There's also the promise that there's going to be revenues that aren't necessarily written into the budget that come from tariffs. And this has been a pretty big proposal from a lot of Republicans that have argued we're not even including the pay-fors that come from these levies. The Yale Budget Lab estimated that all tariffs to date in 2025 would bring in roughly $2.3 trillion of the next decade if they were to remain in place, even accounting for some of the negative economic effects. How much is this going to be the quiet arguing point behind the scenes?
I think that loses steam as they've put in these pauses and capitulated. Even if you look at the deal with China right now, where we've gone back down to that 30% tariff rate, if that expires, it would bump up to 54%. So speaking of campaign promises, it would be right in line with Trump's campaign promises. What that means, though, for this budget is that the potential revenues that could be used to offset aren't necessarily going to be there in the same way. You're just going to be looking more at that $700 billion level that was first, analyzed. I think Yale also put out an analysis about that prior to the April announcement.
This is a moving target, of course, but what is your base case now for trade? What does policy look like by year end?
By year end, I do think we get that 10% universal tariff. I think you have a 54 to 60% on China. What's been interesting is how much we've capitulated on almost every single negotiating piece with China, even to get us to that 30% right now. So there could be additional wiggle room there, but I do think that we might actually end up right where Trump wanted us, right? And at the end of the year, at that 10 and 60 with some, very specific reciprocal tariffs that, would impact other Asian countries.
Do you have any sense of what was gained in some of these negotiations, particularly on the U.S. side from China?
Well, the only thing I think we know right now is that we're now going to be able to send over Boeing planes, right? That's really the big, give back. Plus, they reduced their tariff rate on us to about 10% on a temporary basis during that 90-day window. So we got a little bit back, not anything significant over the long run, but I think that just again highlights that while we're getting some certainty, right, we're starting to see the plan get fleshed out, we are still very much in the sausage making process, and that this is not final. And so it does really get back to that broader sort of call for us that while markets are up, that is still market volatility, right? And so we're still in that Q1 through Q3 sort of market volatility window. And once we get this budget finalized, I agree with Besant, there's going to be a lot more clarity. Discussion isn't going to be about taxes anymore. We can pivot to other things, and then it's going to be about that growth, that pro-growth policy agenda.
Deregulation, tax cuts, etc. Something that the Treasury Secretary would like us to spend a little bit more time on, I think, away from trade.
We would be happy to if everybody wasn't trading around every single headline like a whack-a-mole in every single hour or day. And that's really the ultimate question. How do you get to that when there still is that uncertainty of, is it just Boeing planes? What happened to the rare earths minerals?
Yeah.
There's some discussion that maybe permitting is going to be easier for U.S. companies, but unclear.
I think it's a pretty safe assumption right now that 10% baseline tariff is going nowhere, based on the comments we've heard from the administration over the past few days. Monica, good to see you. Monica Guerra there of Morgan Stanley. Equity futures on the S&P 500 this morning, negative by a few tenths of 1%. Up next, Chris Meekins of Raymond James on why President Trump's plan to cut drug costs isn't clear-cut. From New York City this morning, good morning to you all. You're watching Bloomberg TV. Inflation data 60 minutes away. Andrew Hollenhorst of Citi in the last 24 hours pushing back his rate cut bet from June to July, writing this morning. Lower tariffs mean lower inflation and less downside for growth. The Fed will need to see more evidence of slowing activity to cut policy rates, and we now expect that next rate cut to be in July. The call from Citi in the last 24 hours. Equity futures right now negative by 0.25% on the S&P 500. We're down 0.2 on the Nasdaq. Some big moves elsewhere. The big mover you're seeing in the pre-market, United Health. Let's get to that right now with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Yeah, starting with that breaking news about an hour ago, we learned that United Health has suspended their outlook for 2025 after already cutting it in April. The issue for them, higher medical costs have caught them by surprise. It's been a turbulent time for this company since the gunning down of a top executive in December. Within this announcement, they also announced a new CEO after the prior one stepped down for personal reasons, the new CEO being the current chairman of the board, who was CEO as recently as 2017. So those shares plummeting this morning, down 10.5%. Also falling by a big clip this morning is Hertz, down nearly 9%. It gave earnings after the bell yesterday. The revenue loss was worse than expected, falling 13%. This is the first earnings report for Hertz since it took away EVs, since it started to slim down its offering. The issue, though, was demand. It said leisure demand, that was higher from a year ago, but business, government, all of that demand was falling. So you get the fall there. Now, one company that is having no issue with demand whatsoever is On Holding, the Swiss sneaker company, reporting not just a beat, but a raise for their full year outlook, too. That raise assumes current tariffs, which maybe isn't as far-fetched as an assumption as it once was. But the co-CEO there saying, and this is a direct quote, that come hell or high water, we can handle whatever storm comes our way. They said that demand is so strong that tariffs essentially will not impact them. Those shares up 5.2%, John.
Danny, thank you. Appreciate the update. Fair to say their consumer has some price tolerance, right?
I was going to say the exact same thing. At what point is this a luxury product, except on the lower end? So they can basically say another $5,
See those sneakers absolutely everywhere. Equity futures more broadly negative this morning on the S&P by 0.25%. On our radar this morning, President Donald Trump landing in Riyadh for his first scheduled foreign trip, looking to secure billions of dollars in investments and deals, at least $1 trillion from Saudi Arabia in particular.
And where will that investment go? Will it go in the chip sector from the U.S. to go into the chip sector in Saudi Arabia as they try to expand some of that? Annmarie coming out with reporting talking about the potential for NVIDIA to supply some of those advanced chips. And you have to wonder how much, to your point earlier, this was a sort of tit for tat agreement that on one hand they would increase production of oil, lowering oil prices, while on the flip side they would invest potentially $1 trillion in U.S. industry at a time where they need a number of the things that the U.S. industries actually do produce.
And none of us know if that was a formal agreement or not, but let's just say if both sides get what they want, both sides are happy.
It depends on what else gets agreed to. And that's why this is the other leg of the trip that's going to be very interesting, and that is the geopolitical side of things. When people say there isn't that much upside left, the real question mark is there a resolution to some of the geopolitical issues that have been ongoing? And that could end up being some more upside risk. And that, I think, is what a lot of people are watching to emerge potentially from this trip.
Annmarie, on tour with the president. We'll catch up with AMH a little bit later in the programme. Elsewhere on trade, Treasury Secretary Scott Bessent weighing in on potential next steps. Optimistic about a renewed US-China relationship.
Where we were with 145 and 125 was the equivalent of an unintended embargo. That is not healthy for the two largest economies in the world. We can proceed from here. We have a very good framework. We could do a big, beautiful rebalancing.
A big, beautiful rebalancing. The Treasury Secretary taking the words from the President of the United States, maybe.
I feel like I should go home and say to the children, this is the big, beautiful dinner.
What does the big, beautiful rebalancing at home look like?
Here, you get a chicken leg. Here's the question going forward. What does this look like between China and the U.S.? I mean, ultimately, do we have a sense of what strategic decoupling looks like and exactly how that gets passed through, given the fact that China's red line has been some of these chip exports and some of the inability for them to get some of the more advanced technology? There are a lot of question marks remaining. I mean, the whole thing with rare earths is really important because some people said that was actually a deal breaker for the U.S. and that the U.S. was going to run out of magnets from China that were instrumental in a lot of the technological output of this nation. So there are a lot of questions around how much has actually been resolved.
A big chunk of the tariff on China right now is fentanyl. And that came up in the conversation with the Treasury Secretary yesterday, Scott Bessent, who said that this was a big feature of negotiations, that they're prepared to make some commitments to do something about it. And if they can, fantastic news, because that's been a huge problem in this country. And let's hope that's the next step of talks, that they secure some kind of commitment to prevent the flow of fentanyl from China into the US.
There were reports that Treasury Secretary Scott Bessent took a pinch of sugar on the table during negotiations and said, if this were fentanyl, this would kill you. And this is the reason why we don't want this coming into the country. And a real question now of what those crackdowns look like and how China treats people who produce fentanyl and export it the way that they would if they were going to keep it in China.
It's been shocking, and it's been shocking for quite a while. I want to get you an update on news elsewhere. The US collecting a record $16 billion worth of tariff revenue in April, helping to limit a further widening of the budget deficit. That's a 130% increase year over year, and the biggest monthly customs total in at least a decade. And they might need that money based on some of the tax cuts they want to deliver down in Washington, D.C.
Considering that they're going to increase the deficit by an estimated $2 trillion, a real question here about how long these duties can continue, right? This sort of push-pull of how much can you increase levies while maintaining trade enough to collect said levies? And is that 10% figure, possibly going up to 30% for China, going to engender enough trade that you can count on some of these revenues to offset some of the spending proposals?
Bond yields this morning down a couple of basis points to the front end. The long end, we're down about 1 or 2 on a 10-year to 4.45. Let's turn to pharma. President Trump signing an executive order to lower domestic drug prices and even the playing field.
We'll no longer tolerate profiteering and price gouging from big pharma. My administration will secure what we're calling most favored nations drug pricing. The principle is simple. Whatever the lowest price paid for a drug in other developed countries, that is the price that Americans will pay.
Chris Meekins of Raymond James writing, the reality is that despite that Trump may want to be true, he is very limited in what he can do. Chris joins us now for more. Chris, welcome to the programme. We're familiar with the problem, the price disconnect between the US and the rest of the world. What do you make of the remedy down in Washington, D.C.?
Yeah, I mean, the reality is during Trump's first term, he was really all bark, no bite on drug pricing. There were a lot of headlines. There were a lot of news. There was a lot of talk of how prices are going to be paid. And then even after he left office saying, look how much he lowered prices, which wasn't particularly true. So the question becomes, is he going to use the tools that are available to him, and he has some, to lower drug prices, or is he going to continue to just talk? And yesterday's executive order was a lot of words on a page. Not really sure it will result in any real changes to what Americans pay for pharmaceuticals.
Chris, this program's very popular in the Middle East. If the president was just sort of tuning out of the lunch he's in right now and tuning into Bloomberg Surveillance, what would your advice be? What tools are available? What policy levers could he pull?
Well, the beauty of my job now is my job is not to make policy. When I was working at the Department of Health and Human Services, or as a chief of staff on Capitol Hill and a health policy advisor to a physician member of Congress, my goal was to try to help them formulate policies that would be in the best interest of the country. I think all Americans agreed that what other countries pay compared to what Americans pay does make it feel like the U.S. is having to carry a greater portion of the load. But when you look at what Congress has given him the authority to do with regard to Medicare negotiation, there's a lot of options available to him for how he goes about implementing that negotiation process for Medicare for those limited number of drugs. But at the end of the day, if you want to do the big stuff, you got to get Congress on board. And I just don't think they're in a position where they're going to give him additional authority in this area.
Chris, is this one lever, though, that is going to be pulled, the idea of negotiating with Medicare and possibly even with Medicaid to bring prices down from drug makers, if not some sort of wholesale shift in the way that the U.S. is charged?
Yeah, so the Inflation Reduction Act that President Biden signed into law gave Medicare the ability to start off at 10 drugs, then 15 in 2028. They will be able to negotiate the prices for 20. President Trump cannot unilaterally change the law and increase that number. He cannot unilaterally and be in accordance with the law, negotiate prices in Medicaid. But Medicaid already gets best price in the United States. And so when we look at this, there's a lot of talk of what he wants to do and what he would like to be so. But there's a process, and Article 1 exists, which says the Congress shall, and gives a lot of authority to Congress. And the presidency is not Article 1, it's Article 2 of the Constitution. And that is inconvenient for someone that wants to make real changes for the American public, but that is the system that the founders established.
How much are the buyers of pharmaceutical stocks fully aware of this and not discounting at all the idea that anything really comes through that can meaningfully reduce their profits from U.S. sales?
Yeah, I mean, look, they're aware of this. They don't care whether the money comes from overseas or whether it comes from Americans. They just want the revenue targets to hit and the return on the investment that they've made in these companies and in the biotech companies that are developing these really innovative treatments. America is the biotechnology leader of the world. So investors realize that, but if you look at what performance has been year to date, we're about 10% below what is the traditional multiple for these names. And a lot of this has been the fear over what President Trump may do. However, yesterday, right after the executive order, you saw the pharmaceutical space rally, you saw the XBI rally, and the reason was they realized, like I did, that, you know, when you look at the substance of this, it was a little light.
Hey, Chris, appreciate the update from you, sir. Chris Meekins there of Raymond James. And speaking to what Chris is saying was the move in the market anyway. The fact that some of these drug makers actually rallied off the back of the announcement, I think, spoke to some of this.
All bite, all bark, and no bite, given the fact that ultimately he can't really do that much. It's not maybe the lack of desire. It's maybe the lack of ability.
Lots of news elsewhere, so let's get you an update on stories elsewhere. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. Goldman Sachs says the Buy America trade may be back. The firm now sees the S&P reaching 6,500 in the next 12 months. That's 300 points higher than its previous estimate and about an 11% gain from yesterday's close. Goldman had cut its S&P 500 forecast twice in March, citing higher recession risk and tariff-related uncertainty. Meanwhile, the U.S. is projected to lose $12.5 billion in travel revenue this year. The World Travel and Tourism Council telling Bloomberg visitor spending is estimated to fall 7% versus a year ago. The decline in tourism is attributed to a strong dollar, some lingering COVID-era travel requirements, and a shift in people's views due to President Trump's America First rhetoric. And in sports, the New York Knicks are one win away from the conference finals after beating the Boston Celtics in Game 4. Jalen Brunson had 39 points and 12 assists, while Celtics star Jason Tatum suffered a serious leg injury after scoring 42 points. Elsewhere, the Minnesota Timberwolves are one win away from the next round after beating Golden State. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, making a fair deal.
This is a pause down to 10%. I'm not saying that they're going to go up, but it would be implausible that they would go below 10. We have to have a fair deal for the American people.
That conversation up next with BlackRock's Mike Pyle, live from New York City. This is Bloomberg. A lot of banks pushing back rate cut bets. We saw it from Citi, from Barclays, from JPMorgan, this from Goldman. We expect the Fed to begin a series of 3 cuts later than we had previously expected. They now look for that to start in December versus their previous expectation of July off the back of the trade truce between the US and China. So some big changes for rate cut bets in the past 24 hours. Big changes to this equity market as well. Big rally yesterday by more than 3% on the S&P. This morning, we pulled back by just 0.2%. Under surveillance this morning, making a fair deal.
This is a pause down to 10%. We will be working to see where their final reciprocal number ends up. I'm not saying that they're going to go up, but it would be implausible that they would go below 10. We have to have a fair deal for the American people. Tax, trade, and deregulation all coming together at the end of the year.
So here's the latest this morning. The US and China are agreeing to slash tariffs for 90 days as investors look ahead to CPI data out in just under an hour's time. Mike Pyle of BlackRock and former advisor to President Joe Biden is writing the following. While tariffs will impact growth and inflation, the underlying health and resilience of the US economy and corporate sector are still strong. Mike joins us now for more. Mike, good morning.
Morning.
That resilience is something we've underestimated repeatedly coming out of the pandemic. Do you see us doing the same thing all over again?
Well, listen, I think one of the stories of the year has been how big and how frequent the swings in sentiment have been. And yet sitting beneath that sentiment has been, just a much more kind of constant set of fundamentals. And that fundamental picture does look like one of, ongoing U.S. corporate health, ongoing U.S. corporate strength. And I do think that against that backdrop of huge swings in sentiment, that underlying resilience is something that has been underestimated.
How stable do you think the hard data will be in the coming months? There's been a huge debate already around this table this morning about whether we should ignore the incoming information based on the fact that some of it has been implemented off the back of what we've seen over these talks over the weekend.
Listen, I think that the next period of months is going to be really interesting. I mean, I'm hopeful that we're going to get a period where we have some greater stability in the policy backdrop for 2 to 3 months, where sentiment is going to be more stable. And hopefully that's a window that gives us the beginnings of a real read on how this still pretty considerable shock is going to flow through to the economy. It's going to be hard in the first month or two because there is going to be a lot of noise, but over 2-3 months, I think we should begin to get a picture of just how considerable it is.
What's your expectation for what the contours of the ramifications of this shock look like in the real economy?
Well, certainly that picture looks better than it did on April 2nd, looks better than it did even 36 hours ago. But on balance, and I think we've heard this from the Fed as well, it does mean somewhat slower growth. It does mean higher inflation, at least in the short term. And I think it does mean that, the tariffs that do remain are going to have to be absorbed either in prices or in margins. And that changes the outlook for what we can expect in terms of growth and profitability here in the U.S.
Right after April 2nd, there was a discussion about a structural change in investment. The idea that suddenly people wouldn't want to go into dollar-denominated assets in the same kind of way if you had a different framework for trade entirely. Have we put that genie back in the bottle? Has that discussion been put to bed in your mind?
Listen, I think that when it comes to the dollar, as it comes to a bunch of other moves in financial markets, again, I would just emphasize we saw huge swings in sentiment. And I would always want to distinguish between perhaps the way in which we were overly positive on U.S. exceptionalism coming into 2025 and then overly negative on U.S. exceptionalism coming out of April 2nd. I think the reality is, the dollar is at the center of the global financial system. That is an extremely sticky phenomenon that's been a part of our backdrop for decades. That being said, I think when you look at the picture overall, you see the likelihood of ongoing twin deficits, those fiscal deficits still being high, likely the trade deficits being high in part because of those fiscal deficits. And that on balance, I think, means the dollar is likely to be on something of a weakening trend, but nothing like a change in that basic fact of the dollar being at the center of the system.
Mike, just to build on that, to finance that deficit, to encourage international investors to come in, quite simply, there are two ways. Either that dollar gets weaker or yields need to come up. How do you see it?
I mean, I would say a little bit both and, plus that ongoing corporate quality, corporate resilience still being sufficient to attract capital from overseas. So yeah, are the pressures on the U.S. Treasury curve likely to be higher, particularly at the longer end? Yes. Are the trends around the dollar relative to the strength we've seen in the past handful of years likely to be weaker? Yes. But there is a lot of appeal to U.S. denominated assets still, particularly in the corporate sector. And I think that's why we expect to see ongoing flows and positivity around U.S. equities from here.
There's been a big question mark on that over the last month. And we've talked a lot about the push dynamic. Policies here in the United States pushing capital out abroad. What about the pull dynamic? Are we doing the right things in Europe to attract that capital and compete with the flows that have been going over to the United States for much of the last decade plus?
Well, so I'd say two things. I'd say, one, I think Europe is in some ways the flip side of that sentiment fundamental story that I'm telling about the U.S. We saw a big change in sentiment around Europe. Europe couldn't have been less loved at the end of 2024, couldn't have seen a bigger shift in that short-term sentiment coming into 2025. But that's different than has the fundamental picture in Europe changed. Yes, we've seen some steps forward. Yes, Germany has stepped forward on fiscal and on public investment, but there's some longer term changes around competitiveness, regulation that need to happen. I guess the one additional point I would make is there's a lot of uncertainty out there right now. And I still think the environment for taking big directional bets is probably a hard one. That doesn't mean go into cash. It does mean be thoughtful about where you're looking for return, where you're looking for diversification. And I continue to think that more market neutral strategies are the place where investors should be looking to go to find those things against a backdrop where directionality is hard.
So what does market neutral mean at a time where some of the offsets to risk might not work in the same kind of way?
Yeah, so I think one thing you've seen a range of strategies, a range of portfolio managers do at BlackRock is take advantage of volatility markets. What do we know right now? Volatility is heightened. What do we know? This is a market that's primed for reversals. And so, Rick Reeder's been talking about, at the nadir, selling puts into that moment. Now that we've come out looking to sell calls, using strategies to generate alpha that takes advantage of the fact that this is a market that has a lot of volatility, a lot of reversal, and pulling alpha out of it.
I wanted to finish on Europe. Are you worried about the Europeans in these trade negotiations?
I think it's going to be a hard negotiation. They're a big economy. They're a big trading partner. Both sides have a lot of leverage points against one another. And I think that's going to mean a pretty hard-fought negotiation. I don't know where it's going to land, but it is one that I'm keeping a close eye on because I don't think the fundamentals set up particularly well.
When the president was speaking yesterday, it's the one thing that jumped out. He's meant to be talking about an executive order addressing drug pricing in America and managed to switch to Europe, calling them nasty and in some cases, many cases, nastier than the Chinese.
And saying we have all the cards and, basically they need to give us something really big. Who is they? And this is but ultimately the problem that Scott Bessent put out there. They don't have that collective bargaining type of oomph. And without that, how do they even come to some sort of agreement with some really thorny issues like the VAT tax, as well as some of the restrictions on U.S. tech?
I still don't understand the issue with the VAT tax.
I don't either.
Because it doesn't discriminate against domestic or international product. Everyone has to pay it.
It's just something that seems unfair in a calculation that has to do with goods deficits, that doesn't include services deficits, that people are kind of struggling to.
Is that something about revenue collection? Is that what that's about?
It's about non-tariff barriers that make things more expensive than they seem on the surface from their prices. This is my interpretation. I'm doing my best. You look like you're confused.
I'm still struggling with it. I don't think they've done a great job of articulating the actual issue. Do you understand it?
I think that it's clear that the administration views the VAT as a non-tariff barrier. It's not obvious to me how I should think about that conceptually.
It's not obvious to me either. The way I hear the president talk about it, I think he sees it as the US companies are being punished and the European companies are not being punished in quite the same way in the US. That's the way he talks about it.
There seems to be this bigger animosity, and it has to do around autos. It has to do around agriculture and the sense of why are our eggs not good enough for you? Why are our chickens not good enough for you? And it seems like it's rooted in some really personal disputes over standards around health and food and other things. I will just say anecdotally, the food in Europe does taste better, but don't tell anyone I said that.
The you sounded personal. I eat the eggs. Mike does too. Mike Pyle of BlackRock. It's good to see you, sir.
Good to see you.
Thanks for dropping by. Coming up on the programme, Emily Roland of John Hancock, Tom Forte of Maxim Group, Tiffany Wilding of Pimco, David Kelly of JPMorgan. CPI inflation data 34 minutes away.
There are so many angles to this tariff and non-tariff as we reconsider what this pause means.
The shock of the tariff announcements has clearly, weighed upon international investors.
We now have the market saying, well, maybe the growth outlook is not that bad.
The question is, how are the headlines going to progress from here?
It's certainly too early to declare all clear.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, and your scores look like this. In the equity market on the S&P 500, a small move lower. We're down by 1/10% on the S&P 500 following a major move higher, up by more than 3% in yesterday's session. The focus now turns to the data. Kinda. We'll get to the kinda in a minute. CPI data at 8:30 Eastern Time. Retail sales on Thursday. Let's deal with the kinda, because most people assume you could now ignore the data for the next several months.
It's going to be incredibly messy, having both pull forward as well as push back types of ramifications, influences, as well as this question of how much is this backward-looking data at a time where policy has been moving faster than any real-time implications for the economy can be tracked. Here's what we're seeing from Wall Street. Across the board, they are downgrading their expectations for inflation because of the tariffs coming down from China, and they are also increasing their expectations for growth. In other words, pushing back when the Fed is likely to start cutting rates. So is the threshold now higher for the Fed to cut if you don't have some of the downside pressure potentially on growth?
Is there some tension in that view? As you said, they're downgrading their outlook for inflation and pushing back their view on when the Fed starts to cut interest rates. Is there some tension there? Does this reopen the door for them to consider, as you've pointed out earlier this morning, the right kind of rate cuts?
Right now, all I can say is there's tension everywhere, and to try to come up with anything cohesive that feels definitive is absolutely impossible. So absolutely, there is tension here on many levels. There's a question of if you lower inflation, you're lowering it to what? From where? Okay, maybe the worst case scenario is not there, but don't you have some sort of inherent implicit increase in inflation over the medium term if you have companies that are able to pass it along, and tariffs that aren't nothing, they're bigger than they were before. And then on the flip side, you are going to have a growth hit. It might not be a recession, but you do have a growth hit that might not transpire in the employment data in the same way that gives the Fed the chance to cut rates. You put this together, what do you get? It is a soup. It is a wait and see. It is difficult for companies to really know how to proceed.
I just struggle with this idea that the trade war makes it difficult for the Fed to cut and the trade truce makes it difficult for the Fed to cut.
I think you're not alone. There are a lot of people who are saying that the Fed is still going to cut significantly. Interesting, Andrew Hollenhorst, and you mentioned this earlier, and I thought that it was a good thing to bring up. He talked about we now expect the next rate cut in July with risks balanced toward a further delay. So this idea that if they don't go again, there is the risks on both sides that's one and done, right? Even though before they had talked about 125 basis points of rate cuts.
Okay. Made enough pretzels around this table,
well,
haven't we?
Come on, that's kind of what we're dealing with.
Me as well, both of us.
Sorry.
Equity futures right now, the S&P 500, negative by 0.2%. Coming up this hour, Emily Roland of John Hancock as Buy America makes a comeback. We'll catch up with Tom Forte of Maxim Group on the surge in big tech, and David Kelly of JPMorgan reacting to the latest read on inflation. We begin this hour with stocks edging lower following a major relief rally. Emily Roland of John Hancock writing, for markets, it was all a bad dream. But the prime momentum winners of the trade war, most notably Europe, may not be getting that same continuous bid. Emily joins us now for more. So, Emily, are we saying the winners of the war might be the losers of the truce?
Well, we've just seen this incredible momentum out of Europe, European financials in particular, wearing the crown of momentum, up about 33% year to date, as we saw this sort of sell everything America. U.S. exceptionalism was over. And where do you put those assets? Over in Europe. So I think that trade could potentially take a break here as you see this sort of cautious optimism opening up as it relates to U.S. assets here. Frankly, the fundamentals and the macro backdrop would suggest leaning further into the U.S. over Europe here.
Emily, can we deal with the cautious piece of the cautious optimism? What is there still to remain to negotiate, to reconcile, to resolve that keeps you cautious?
Well, there's certainly some uncertainty still around how tariffs play out. But, John, the problem is you wake up this morning and it's like, again, it was all a dream. The S&P 500 is trading at 21 times forward earnings. We started the year at 22. We've got a little bit to go to get to all-time expensive levels on the S&P 500, but we're there. High-yield bond spreads this morning at 305. That's just about 50 basis points away from historical tights. Markets now are flat for the year if you look at the S&P 500. So there's really not a ton of value, and we're back to stocks being expensive here, especially some of those momentum winners.
So if you are feeling cautious, Emily, what's the caution trade, given that there are a lot of question marks around some of the basics, as you just heard us try to make sense of and maybe make more of a confusion, but there isn't this sense you can just hide out in the dollar and hide out in treasuries in the same way as in the past?
Yeah, I mean, we look at bonds as still being attractive here, 480 on the aggregate bond index. Bonds have cheapened up here a bit as we saw that backup playing out yesterday. I thought it was pretty notable to see Treasury yields backing up yesterday. It kind of was a signal that maybe inflation wasn't really the key issue, concerns about inflation as it relates to tariffs, but it was more of the growth scare that was impacting the Treasury market. So you're seeing yields back up. We would look at that here as a gift. We would also think about trimming areas that have run a ton. We talked about European financials, the fundamentals and the macro backdrop not really supporting that as earnings are coming in about -4% year to date in that space. You look at mid-cap growth stocks. That's been another relative winner. The best performing areas of the U.S. market this year have been U.S. large cap value and mid-cap growth. There's a couple of names in there. The biggest name in the mid-cap growth index sports a trailing PE ratio of 500 times. Another big name in the index takes on leverage in order to buy Bitcoin. So those names are up 40, 50% year to date. We would look to trim into some strength there. When you wake up in the morning and Bitcoin's at a new all-time high, that is a sign that markets aren't necessarily focused on fundamentals. And it's notable to see how things have shifted. In the beginning of April, it was great not to have a lot of risk in portfolios. And it feels like now you can't even have enough risk in portfolios here in order to participate. So we want to be mindful of that as momentum continues to rally.
There's a lot to unpack there, including how Bitcoin is on your dashboard as sort of a sell indicator. Emily, you did say that it was a gift to buy long bonds at these types of rates. And I want to just dive into that a little bit more at a time when people are really debating how much the current budget could potentially influence yields, how much longer term inflationary impacts from tariffs that are still higher than where they were at the end of last year could also push that yield higher.
Yeah, so it's all about inflation here in our view. And what you saw, there's a few dynamics playing out here. One is that, remember, companies pulled forward a lot of demand. We saw it in the GDP data. We've seen it in the PMI data. The companies overstocked. They have a ton of inventory. At the same time, where there are some cracks in the U.S. consumer, we've talked ad nauseum about the sentiment data. Consumers are worried about their jobs. They're worried about spending. So I think it's going to be difficult for companies to raise prices at a time where the consumer is not necessarily in the best shape. The other element here is housing. Housing is inflation. So we continue to watch that shelter component closely. Last month, the BLS reported that shelter inflation was at 4%, but there's a pretty long lag with the real-time data. If you look at Zillow home price data, it's up about 1.4% on a year-over-year basis. So we think that the official data starts to catch up with that. There's significant issues with housing demand, again, around consumers pulling back. Unaffordability is an issue. Insurance costs are elevated. And we're seeing really big jumps in housing supply at the same time. So we think if housing inflation can come down along with commodity prices, you have a disinflationary story playing out. And frankly, Lisa, bonds are not sniffing that out yet.
Emily, consumer discretionary, with that in mind, rallied yesterday by more than 5%. What do you want to do with that now? How do you want to manage your exposure to that group of stocks?
Yeah, so consumer discretionary would be a neutral for us. I think there's some names in there with pretty decent earnings growth prospects, but again, it's more cyclical. And you've seen, in addition to that, industrials are now the best performing sector in the S&P 500. So you've completely shifted away from this more defensive tone permeating markets back towards cyclicality. We would take a middle of the road approach where you're looking for quality stocks that are trading at a reasonable price, companies with great balance sheets, lots of cash. That had been the baby that was thrown out with the bathwater. We're starting to see quality pick back up here, but we still think that that's the name of the game as we contend with the remainder of this year.
Emily, is it fair to say you're somewhat defensive right now? You seem almost cautious, talking up the prospect for bonds and moving away from the high flyers from yesterday's session.
Yeah, I mean, that's the way, frankly, we came into this year. And it was really not necessarily anything to do with the geopolitical backdrop. It was just the fact that we saw 25% back-to-back returns on the S&P 500 in 2023 and 2024, and that valuations were elevated. We were a bit cautious because of that. It's still, constructive. We still want to own risk assets in portfolios, but to expect another kind of period of really strong multiple expansion, we think was overreaching. We look at 10% earnings growth being baked in for 2025. That's probably a little bit optimistic here. We're still overweight U.S. stocks. We still like U.S. large cap stocks here, just a tad bit more cautious. We like areas like infrastructure. It's the stuff that people need versus the stuff that they want. And then we are finding some value here still on the fixed income space. I know overweight bonds versus stocks has been kind of the widow maker, but we still think that stocks are priced for perfection while bonds are likely mispriced here.
Emily, appreciate the input. As always, Emily Roland there of John Hancock, making the case for fixed income and bonds over equities.
And it's a cautious case. It's talking about the potential for some sort of rolling over in economic growth, but also disinflation coming from housing prices. You know what occurred to me as I hear everyone kind of making pretzels and discussing these small little points that might hold value? Macro trading is dead. It feels like right now, if macro trading hinges on headlines, and so people are looking for things that are not correlated to these sort of headline risks in the same kind of ways. So they're looking for these small little pockets and kind of adjusting and tweaking and, tinkering.
It's been a great month. You not had fun?
Who?
Been phenomenal over the last few weeks.
I mean, okay, but if you put money at risk and you said, okay, now I have a framework.
Times. Love it.
Okay.
Whipsawed from one headline to the next. Everyone at home's enjoyed every second of this.
You seem incredibly excited and happy after the past month.
My head's still spinning. I don't know about yours.
Mine too.
Equity futures on the S&P recovering somewhat, down by just 0.1% on the S&P. With an update on stories elsewhere with your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. House Republicans unveiled details of their long-awaited tax package. The draft bill includes many of President Trump's campaign pledges, including no taxes on tips and overtime pay. It also makes permanent the lower individual tax rates Trump signed back in 2017. It does not, however, include a tax hike on the wealthiest Americans. The Trump administration is preparing to announce a deal to grant Saudi Arabia more access to advanced semiconductors, allowing the country to increase its data center capacity. Sources telling our own Annmarie Hordern the agreement would boost the country's ability to buy chips from NVIDIA and AMD. The deal could be announced as soon as this week. And Coinbase, the largest U.S. cryptocurrency exchange, will be added to the S&P 500 next week, the latest milestone for the digital asset industry. Coinbase shares have climbed 260% in the past 2 years, valuing it at roughly $53 billion. The company will replace Discover Financial Services in the index prior to the start of trading on May 19th. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next, the morning calls, plus Tom Forte of Maxim Group as big tech enters a bull market. In just a moment, we'll talk about tech names. Then later, 8:30 Eastern Time, US CPI just around the corner. Live from New York City, this is Bloomberg. One hour, 14 minutes away from the opening bell with equity futures slightly negative. We're down about 0.1% on the S&P 500. On the Nasdaq, just turning positive by 0.04%. CPI data 14 minutes away. Let's get you some morning calls. First up, Morgan Stanley cutting its price target on Airbnb to 125, pointing to weak guidance due to soft travel demand. Your second call from Raymond James, initiating coverage of Supermicro with an outperform, calling it a market leader in AI-optimized infrastructure. That name is up by 1.3%. And finally, D.A. Davidson reiterating its neutral rating on Alphabet, saying a complete breakup of the company would unlock value. That stock is negative by 0.2%. Let's keep it on tech. Apple considering raising iPhone prices. The Wall Street Journal reporting Apple may hike prices of its new lineup this fall to avoid the perception that hikes are tied to US tariffs. Tom Forte of Maxim writing, we believe Apple will mitigate tariffs by working with its suppliers, bearing some of the costs itself, and raising prices for consumers. Tom joins us now for more. Tom, good morning, sir. It's good to get you back on the programme. What gives you the impression that people would be willing to pay more for an iPhone?
Yeah, so Jonathan, when you think about Apple raising prices on the iPhone, they have a lot of levers they can pull. They can make the Pro model more expensive. They can make the models that have more memory more expensive. So it doesn't necessarily mean an across-the-board raise. But I do think Apple has pricing power. And I think some of that pricing power comes from the fact that you're seeing some very heavy subsidies from the carriers who are competing against each other. So I think that they're not just raising prices for consumers, but potentially raising prices for carriers.
So, Tom, that upgrade cycle that a lot of people talked about over the last several years that has somewhat remained elusive, Tom, I just wonder how much of a headwind higher prices would be.
I'm thinking about the term elusive, but yes. So the upgrade cycle that never was. So I do think, again, the ability to raise price comes from Apple's status as a premium brand, the strong demand for the iPhone, irrespective of the upgrade cycle, and then also from the benefit of the carriers heavily subsidizing for competitive reasons.
At this point going forward, Tom, how much is Apple in a unique position of hurt when it comes to the tech sector, both by their footprint in China as well as their consumer-facing product that is competing with a host of different other counterparts that have adapted to AI more quickly?
Yes. So clearly, Lisa, what you've seen is that the good news is that the tariff outlook is much better than it was before, but the competitive set in China hasn't changed. And I think when you compare Apple with the other mega caps, Microsoft, Google, and Amazon have the benefit of large enterprise sales from their cloud computing efforts. And Apple is, heavily dependent on the consumer, and as you pointed out, has a much more competitive environment, including in China. You did see a material improvement in sales to China consumers in the March quarter versus the December quarter, but it was still down on a year-over-year basis.
Which brings us to today, Tom. We saw this knee-jerk reaction yesterday in big tech, responding massively to the upside in response to a ratcheting down of tensions between the U.S. and China, bringing tariffs from 145% on China from the U.S. side down to 30%. And there's a real question over who benefits the most. Do you think that the consumer-facing ones benefit the most, Apple, Amazon, or do you think that ultimately it is really going to hinge on what happens with chips, on what happens with the economy, and that, frankly, it's sort of a case-by-case type of story?
Yeah, so in an either-or scenario, I think the companies that are dependent on enterprise spend. So what did we learn in the March quarter earnings? The big cap tech companies are going to continue to spend to ramp their AI-related efforts. So I'd say right now, those companies that are dependent on that spend are better positioned than those dependent on the consumer, because I think the consumer's got a bit of whiplash right now. And I think there still is some hangover anxiety, tariff-related, and that could, result in softer economic news.
Hey, Tom, thanks for jumping on. Tom Forte there of Maxim Group, the latest there with Apple, potentially putting up prices. And as you pointed out, I think it's important, not all companies are in the same position as that one company, which is widely considered in tech to be somewhat of a luxury item.
There is this feeling that if people are willing to spend $1,200 on a phone, they might be willing to spend $1,300 on a phone, and it isn't going to be as big of a deal as going to the grocery store and paying $8 for eggs rather than $5 for eggs. There is this question going forward, though, about the 1-2 punch that they get maybe from a lack of sales in China, about the potential ability or not to push suppliers to eat some of the costs, and just how much of an advantage they have in the super cycle, given some of the technological advancements happening elsewhere in the smartphone industry.
Not everybody's Tim Cook or Apple, for that matter. CPI drops in about 9 minutes' time. Joining us now, jumping on, Mike McKee. Mike McKee with a preview. Morning, Mike. Tell us what we can expect in a few minutes' time.
Well, we're not, John, expecting a huge change in CPI, an increase in the headline and an increase in the core of 0.3%, but that won't change the year-over-year numbers, 2.4% headline and 2.8% for the core. The real question is, where do we see, or do we see even, some tariff-related increases? You can look at furniture, you can look at electronics, things we get from Asia. Automobiles, did new car prices go up because everybody was trying to buy them, or used car prices because there was a shortage of new cars? So a lot in there to watch for. I thought the most interesting comment today came from the folks at Morning Money over at Politico, who said the Trump administration is the not yet administration. Prices are going to go up, but not yet. The economy is going to slow, but not yet. We're sort of at the end of the not yets. We might start to see some of this start to happen.
Mike, you've seen all the updates coming from Wall Street, the new calls for the first Fed cut, all pushed back. We heard it from Barclays, from Citi, from JPMorgan, from Goldman Sachs. Mike, what do you make of the Fed debate following the truce between US and China over the weekend?
I think the Fed doesn't change its mind at all because, first of all, we still have tariffs of 30% on China and a 10% universal tariff around the world. And this is Donald Trump. He could change his mind again any time. So the Fed is still on hold and going to stay on hold for a while.
To that point, Mike, yesterday we heard from Chicago Fed President Austin Goolsbee in the New York Times saying it is definitely less impactful and stagflationary than it would have been. However, it's 3 to 5 times higher than what it was before. He's talking about the tariff rates. So it is going to have a stagflationary impulse in the economy. Fed Governor Adriana Kugler having a similar type of tone. Mike, is your sense that most of the members from the Fed speak that we have heard and the Fed speak that you are going to engage with, that they're really emphasizing the stagflationary kind of bent to the data and the fact that inflation is going to take probably the bigger emphasis in the near term?
Well, it probably will in the near term unless we have some sort of dramatic slowdown. The odds of that seem to have backed off a little bit. But if you get the kind of inflation they're anticipating, you will have a bump up. The question is, how long does that last? The idea is that tariffs are a one-time increase in the price level, and the Fed can look through that. But if this is going to be an ongoing cycle of tariffs on, tariffs off, then they have a longer-term stagflation problem they have to deal with.
Mike McKee with the latest. Mike, stay close. Mike will break the data in about 6 minutes' time. CPI is just around the corner. The estimate in our survey for headline CPI month over month is 0.3%, stripping out food and energy core month over month. Looking for that to come in at 0.3% for the month of April. The previous month, that reading was 0.1%. You mentioned the governor, Adriana Kugler. The tariffs appear likely to generate significant economic effects, even if tariffs stay close to the currently announced levels. They are staying the course, aren't they? Steady hand.
At this point, if they flipped as frequently as some of the policy proposals did, they would be accused of reacting quickly at a time when policy is uncertain and it takes a long time to get to the economy. If they don't give some sort of guide, then there's a question of what forward policy and the sort of tool that they have, given that communication has been so instrumental for them, about what kind of value that has if they're just saying wait and see over and over again. So they're between a rock and a hard place. Key question that I have is how quickly will some of the effects, the significant economic effects, as Adriana Kugler said, make their way into data that people can rely on? And that's going to be increasingly difficult to tell.
The good news for the Federal Reserve is they only have to put out a forecast every quarter. That's the good news for them. A lot of people on Wall Street do not have that luxury, which is why we see them marking to market or marking to trade negotiations every single week.
This morning I came in and I saw these notes piling up and I thought, here come the revisions. And it's revised in every single different way. You have some people upgrading their revisions for end of year S&P 500, some people upgrading their expectation for growth, downgrading inflation, other people upgrading their inflation forecasts, other people talking about how maybe they should sell here because all the good news has been priced in. So everyone's revising, trying to get a handle on something that we're not going to get clarity on in 5 minutes' time, but we're going to try.
Jonathan Pingler, UBS, said the change in tariffs could imply around 0.4 percentage point additional GDP growth this year and potentially a little boost to next year, too, of 0.2. So that's the direction of travel. Up next, CPI data and reaction from Tiffany Wilding of Pimco, David Kelly of JPMorgan Asset Management. Seconds away from inflation data in the United States, with equity futures almost totally unchanged on the S&P 500. On the Nasdaq, positive by 0.1%, adding just a little bit of weight to the big rally in yesterday's session. The scores in the bond market look like this: the 2-year, 10-year and 30-year firmer with the yield to lower. We're down by 3 basis points on a 2-year. We're down by 2 on a 10-year to 4.44. With your inflation data this morning, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. A little bit of a surprise here with a little bit less inflation than anticipated. The headline comes in up just 0.2%. The forecast was for a 0.3 gain. Same story with core, up 0.2 after a 0.3 forecast. On a year-over-year basis, that pushes the headline down to 2.3%, and the core stays at 2.8%, which is what had been anticipated. The index for shelter up 0.3%. That was more than half half of the all items monthly increase. Energy also increased, up 0.7%. Gasoline index did decline. Food fell 0.1%. Food at home decreasing 0.4%. That's groceries, basically. I'll look into the rest of this, and we'll look for some tariff implications, John, while you check the markets.
Yeah, I'll come back to you in a second, Mike. So unlock some gains in the equity markets, like downside surprise on CPI. Equity futures now firmer by 0.2% on the S&P. Going into the print, totally unchanged. On the Nasdaq, we're up by 1/3% now. If you turn to the bond market, 2-year, 10-year and 30-year, seeing yields fall, down 5 basis points on a 2-year, down 4 on a 10-year. So the yield on a 10-year maturity is 442.56. You know the rules coming into this. The rules were as follows. If the number was bad, ignore it. If it's good, it's really good.
Well, right now, on the margins, you could say that disinflation in a couple of industries could potentially give the Fed a pass to cut rates sooner, even if the pain isn't as great. This has been the argument that Peter Tchir made, that you could actually see 3 or 4 cuts still, even without that downside of recession. And that seems to be what this market maybe is sniffing out peripherally from this data that doesn't really matter, but maybe people will think absolutely does, and that's what they're trading on.
How long is it going to take to get a clear read, a clean read on the US economy?
It's a great question. I don't know the answer to it, and I think nobody does. And that's the reason why they're looking under the hood, just like Michael McKee, to try to understand the details, to see if there's some more insight coming from that.
Mike, have you got a second look for us? What do you see?
We got a second look for you here, and I'd say this fits with the theme that the Politico people had out this morning of not yet. Most of the categories you would expect to rise if tariffs were in place are not up much this month. The gasoline prices were down 0.1%. That's always something that drives this stuff. But if you look at household furnishings and supplies, they were up just 0.2%. And when you look at apparel, it was down by 0.2%. The expectation was it might rise some. New cars up just 0.1%. Used cars down 0.5%. So the big increase we saw in wholesale prices hasn't hit yet. Then you go on and take a look at things like toys. Toys were up 0.3% after falling 0.9 last month. Let's see if that's any kind of a harbinger going forward. We mentioned rent of shelter and owner's equivalent rent. They were not a major contributor this time, or rather they were more, 0.4% for owner's equivalent rent. And then the motor vehicle insurance, which has moved up a lot, up 0.6 again. Video and audio services down 0.6. There was a thought that might be something that would rise because of tariffs. And airfares were down on the month. That was also something that people were watching to see what we would get in terms of people not wanting to come to visit the United States. But right now, we are seeing a decline there. Airline fares off by 2.8%, and that helped keep inflation down, even though it may reflect tariffs and the general feeling about the United States.
Mike, thanks for the breakdown. We'll come back to you in a few minutes' time. Mike McKee there with CPI. So the shorter version of all of that is that we got a downside surprise on CPI, 0.2% against an estimate of 0.3, both on headline and on core, month over month, and that unlocks some gains in the equity market, just briefly up by a few 0.1% on the S&P 500. That's the equity story. In the bond market, unlocking some lower yields. On a 2-year, down by 3 basis points. On a 10-year, we're down by about 2 or 3 basis points as well. The 10-year, 4.45. Joining us now to discuss, Tiffany Wilding of Pimco. Tiffany, welcome to the programme. We were told to ignore some of the data throughout this morning. Can we ignore this data?
Well, yeah, I mean, I think there is a lot. It sounds like there's a lot going on under the hood. But the overall message is that, the U.S. economy prior to any sort of tariff pass-through was just on a continued path towards normalization after the pandemic-related shocks. Inflation was elevated. It's remained elevated. And I think overall this report, suggests that some of that is coming down. And if it weren't for tariffs, the outlook would be towards more moderation. But I do think you have to discount discount this a little bit because we know eventually the tariff costs, which are major, will be passed through to some extent. Now maybe one more point on that is I think the interesting thing is that we're hearing from some of these larger retailers, as they are trying to hold the line on prices, it seems like as long as they can to increase market share, they had the ability to front run this by importing a lot of inventory ahead of time, so they might have a bit more of a window before they really need to raise prices.
That said, Tiffany, if you look at some of the details under the hood, there is this question about whether some of the components that contributed to the smallest increase since February of 2021 are sticky, are durable. And I'm thinking of housing, which we were talking about with Emily Roland earlier, as well as the gasoline prices. How much is that going to be a disinflationary force that will be thematic through the rest of this year?
Yeah, well, certainly we've seen a fall in gasoline prices. I think the interesting thing is if you look at U.S. gasoline and other U.S. energy prices, they have not fallen as much as global oil. So I think it'll be maybe a little bit less disinflationary, than if you're just looking at oil prices. But you will get some benefit from that. I think on the housing side, I think there's real questions here. The tariffs clearly will raise housing costs. The things that we import in terms of appliances, and other inputs into to building homes, most of that comes from China, and so that will cost more. And eventually that will filter through into higher rental prices. Now I think near term against that. We found evidence that the increased flow of migrants into the United States, did raise rentals in sort of the smaller rental apartments and things like that. And we think that's why you saw OER, moderate, come down, inflation come down there much slower than many people were expecting, is because you had this offsetting inflow. Now, obviously, that force is waning and potentially even reversing. So that could result in some faster deceleration near term in some rental costs. But I think ultimately the longer term outlook there is for stickier housing costs as a result of some of these tariffs.
John pointed out that we're all kind of tying ourselves in pretzels as we try to get all these counter forces together, whether it's the immigration story, whether it's the tariff story, whether it's what the economy was heading into all of this. He also asked me, and I had no answer about when the data would be clean, when we would get actually something that we could rely on. So I will ask you, at what point do you think that you can see sort of the new normal in the data, or is that not really going to come back? Are we going to have to watch these trends sort of in parallel fashion and try to compile a picture?
Well, I think that the new normal is, I think we're quite a ways away from that. I think the bottom line here is just that taking a step back from the headlines and things like that, the average effective tariff rate that we calculate as a result of these trade policies has increased more than any time in a century. That is a dramatic economic shock, and it will take time for that to flow through the system. And we aren't going to see the quote unquote new normal on the back of that, we think, for quite some time. When I say quite some time, maybe a year or more for the economy really to adjust, assuming these tariffs stay in place. So, I guess to settle in and let's see what happens.
Do you think you have a best guess right now? Any kind of guess, any kind of take whatsoever on the nature of that shock, Tiffany? I get that it's a policy shock, but is it a inflationary shock, a disinflationary shock, a growth shock, a negative supply shock? What kind of shock is it?
Well, I think it acts like all of those that you mentioned, and I think the bottom line is because we haven't seen the type of a policy like this in quite some time. We don't exactly know how it's going to filter through into the economy. Again, we have a best guess about that, which is that we think you will get some price level adjustment that occurs. Because firms have to pass on the additional costs of tariffs, and they will do so eventually, that will result in a real income squeeze because you don't see wages adjust as quickly. We ultimately think over time wages could adjust, but during that real income squeeze, that just means that real consumption, is hit by that. And there's some knock-on and second-round effects from that. As volumes start to decline, because prices are higher, then that just means you potentially need to hire less people. You'll probably get some margin squeeze. It could be detrimental to investment trends in the United States. I think the magnitude of these things and how they play out over what time frame, I guess is really the question here. And then how inflation expectations adapt to all of this. I think the real concern from the Federal Reserve, for example, is that we've come off of a period of elevated inflation, and having another shock that should be a one-off sort of temporary thing can result in inflation expectations drifting higher, can start to creep into wage negotiations, and can result in more persistent inflation. I think that's what the Fed is concerned about.
Tiffany, appreciate your take as always. Tiffany Welding there of Pimco. Speaking of inflation expectations, you, Mitch, inflation expectations, an update, another read on that on Friday. If you are just joining us, welcome to the programme. Moments ago, CPI, small downside surprise, year over year, 2.8%, the smallest increase since February 2021. Mike McKee, how much comfort can we take from the smallest increase since 2021?
I don't think economists will take a whole lot of comfort for the same reasons that Tiffany was talking about, the fact that we don't know yet where all this is going to show up, but we do expect something to show up. It'll be interesting on Friday to see how this CPI report and the news of what's gone on with China plays into that University of Michigan number, because people have been very depressed about the outlook. Do they feel better, and then do they bring down their inflation expectations? I do want to mention two bits of inflation numbers that the president has harped on. One is energy. He said it's come down. It didn't. It went up 0.7. He should have mentioned gasoline, because gasoline is what was down 0.1%. Natural gas up 3.7% on the month. So energy's still up. However, food prices, as he suggested, had gone down during the month by 0.4, and eggs down 12.7%. So the president gets a win there. Yeah.
The poster child of the inflation story of the last few months. Mike, thank you. Eggs are down. I think it's fair to say that when the president's talking about energy, he's talking almost exclusively about gasoline.
That is what's going to make an impact on people who go to the pump, which is a reason why he cited something below $2 a barrel that people have been looking for. But there is this question of how much that will actually give a tailwind to the real incomes of a lot of people, and how much that's actually going to bring headline inflation pretty much where it is, or a little
Dead on
bit
the money.
lower.
The confidence story, the psychological impact of seeing that framing. It's really, really important. David Kelly of JPMorgan Asset Management joins us now to build on some of this. David, welcome to the programme, sir. What's your initial reaction to these numbers this morning? How useful are they?
Well, usually when we're on this call on CPI day, it's like the biggest news of the week. But today, obviously, it's the tariff news. But also, I think the other big part of the inflation story going forward is the fiscal stimulus that's beginning to emerge on Capitol Hill. Because what it looks like is, OK, the tariffs aren't here and consumers are relatively quiescent right now. I mean, we're not seeing a lot of enthusiasm there with airline fares and so forth down. But it looks like they're cooking into this bill stimulus for 25, 26, 27 and 28. They're implementing a lot of the president's promises on the campaign trail in addition to extending the tax cuts. And if that comes through, you're going to have a surge in consumer spending in 2026, helped by fiscal stimulus, and perhaps even later in 2025. That'll keep inflation a little higher. So this is good news in inflation, but I think the signs are that inflation is going to move up in the short run because of tariffs, and then in 2026 because of renewed fiscal stimulus.
David, is that a reason to be bullish the equity market?
Probably not. The equity market is hard. I don't know exactly where we are right now, but it's hardly down year to date. And we've done a sort of a round trip on tariffs here, but we still end up with a higher tariff rate than we had at the start. I think we've got slower long-term economic growth. So in some ways, the relief rally has been stronger than the downturn. And I think it may be a little bit overdone. So I'd still caution people, longer term, the huge premium that U.S. equity prices have over the rest of the world probably isn't justified. And so I'd still be in the diversification camp here. I do think there's, a 10-year Treasury yield at 4.50 to 5 is probably more reasonable than a big fall from here. But I think it's too early to be really bullish about equities because of fiscal stimulus, because we're talking about a full employment economy where the Fed's going to have less reason to cut.
We've been struggling all morning with whether this really is the beginning of the return to the United States and the dialing back of some of the loss of U.S. exceptionalism types of narratives, or whether this is just a pause in the go international trade. David, you talk about diversifying. What does that mean if you think that 10-year yields are going to be in a 4.50 to 5 range and you don't really find U.S. equities particularly attractive right now?
Well, it does mean international equities. I mean, yes, the U.S. equity market has almost done a round trip year to date, but European equities up very strongly. International equities in general are up strongly for the year, and the dollar is down. I think that will continue because, you know, we will still end up with significant tariffs at the end of all of this, even though we're seeing, you know, it's calming down. We're going to end up with higher deficits. We're going to end up with lower immigration, probably lower economic growth. So I know, you know, this is a package, an agenda that the public has voted for, and that's why we have elections. But it does suggest a slower trajectory in U.S. economic growth with higher deficits, somewhat higher inflation in the short to medium term. None of that is really very pro-U.S. And the thing is, you know, I think the U.S. will do okay, but does it deserve to be, you know, a 50% premium over the rest of the world in terms of PE ratio? So I'd say international equities, yes, and then also alternatives. You know, just if fixed income is not going to help you because of higher inflation, alternatives, there are plenty of alternatives, things like infrastructure, transportation, real estate, which have a degree of inflation protection. So I think people just need to broaden their definition of diversification in this kind of environment.
You mentioned the Fed's response, and this has been a subject of a pretty heated debate. And frankly, it feels like people are bifurcated on just whether this gives the Fed more incentive to cut rates just for the good reasons or less incentive. From your perspective, is this more of a reduction in potential inflation in terms of the lower tariff rate than it could have been that gives the Fed more of an ability to cut rates without a recession at a time where the data that we just saw, albeit messy, does point to something of a much lower pace of price increases?
Well, yes, but the Fed's target is 2. And I think that on the consumption deflation, I think Jay Powell put it pretty well at his latest press conference. You know, they're going to have to look at where they think inflation's going and where they think unemployment is going. And I think the both fiscal stimulus that is beginning to emerge from Capitol Hill and then also a somewhat lower tariffs, they suggest that the risk of recession is receding here. I think it's probably just gone below 50%. So risk of recession receding, maybe the unemployment rate ends the year 4.5% to 5%. But the CPI, the consumption inflation could easily end the year above 3%. In fact, it probably will. So we're probably going to be further from the consumption deflation target than from the unemployment target. In that kind of environment, there's not much excuse for the Fed to cut at all, because we're at fairly close to a neutral level. So I think the Fed will take it very easy here, and it's part of the story is tariffs, but the other part is putting more fiscal stimulus and higher deficits into 2026 really doesn't give the Federal Reserve a reason to be easy.
Is your base case no cuts now, David?
No, not quite. I think we will get at least one cut this year by the end of the year. I think the Fed realizes they can edge rates down a little bit, but I don't expect a cut in June. I don't expect a cut in July, to be honest. And I think they'll want to see much more of much more certainty around what the tariff picture really is and how much stimulus is in this bill before they contemplate any cut. So I think we're going to have to wait some time for the first rate cut.
Interesting. David Kelly there of JPMorgan. David, good to see you, sir, as always. My takeaway from that conversation is how the attention has shifted very quickly from trade to taxes.
And this might not be a picture that is as simple for the bond market. The idea of who is the bigger potential pushback from some of the proposals. Is it going to be other Republicans or is it going to be the bond market? And a lot of people, and that was Peter Tchir's words, I'm copying them, but a lot of people are waiting for that ramification.
I think they were my words, actually, Bramo, not Pete's.
I apologize. Okay, please. They're Jonathan Ferro's words. They're fantastic words.
Let's put that on the record. Very special, important words. 2-year yields are down by a few basis points this morning, down 4 on a 2-year. On a 10-year, we're down by about 2 basis points to 4.45. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara. Hey, Yahara.
Hi, John. We start by recapping the latest economic data. U.S. consumer prices rose less than forecast in April. Core CPI rose 0.2% from March, lower than the expected rise of 0.3%. The data suggests inflationary pressures are limited, but remain at risk of building as companies look to pass on the cost of higher tariffs. Meanwhile, the U.S. is projected to lose $12.5 billion in travel revenue this year. The World Travel and Tourism Council telling Bloomberg visitor spending is estimated to fall 7% versus a year ago. The decline in tourism is attributed to a strong dollar, some lingering COVID-era travel requirements, and a negative view on President Trump's America First rhetoric. And Apple wants you to be able to control your device with your thoughts. According to the Wall Street Journal, the company is taking early steps to allow people to interact with their iPhones with neural signals captured by brain implants. Apple has worked with Synchron, which makes a stent-like device implanted in the brain's motor cortex and is able to read brain signals. That's your Bloomberg Brief. John?
Nope. Hara, thank you. Appreciate it.
I knew you were going to say that.
Honestly, some of the technology out there these days. This could be used in really great ways, by the way. And we talked about it with regards to Elon Musk, people with disabilities. This could be absolutely fantastic. For everyone else, this is just going too far, isn't it?
Sure, if you've had a stroke and you want to be able to communicate in a way that you can, fantastic. We highly support. There's this question about if they don't have our brains enough in the scroll features and the suggested headline features, they need to actually take control of our brains. I mean, what more can we possibly do with this thing?
Manipulate it and all of that stuff. No, want nothing to do with that. And then sell you ads. And OK. Up next, we'll set you up for the day ahead. From New York City, this is Bloomberg. The opening bout just around the corner, 35 minutes away. Equity futures on the S&P just about positive. Your day and week ahead look like this. Later on today, President Trump, of course, in Riyadh for the first stop of his Middle East trip. Look for headlines that come from that. Tomorrow, the president heads to Doha. Thursday, we'll get Walmart earnings, PPI, retail sales, and another round of claims, plus remarks from Fed Chair Jay Powell. And President Trump heads to Abu Dhabi. And on Friday, we get another read on UMich consumer sentiment. Just to wrap up this morning, small downside surprise on CPI, but attention started to shift to the tax bill down in Washington, D.C. The bond market maybe just starting to pick up on some of this.
A real question here about which is going to take precedence at a time where a lot of the data becomes so messy that it's to be rendered useless. So how much do people have to look to forward-looking policy and what actually does get done in Washington, D.C.?
That conversation will continue tomorrow morning. Coming up tomorrow, Victoria Fernandez of Crossmark, Wei Lee of BlackRock, Kate Moore of Citi, and Lindsay Rosner of Goldman Sachs. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Italian Open update for Bloomberg TV and radio from Tennis Channel. So far, so good for Jannik Sinner. The world number one has played 4 sets and won them all on his return to the ATP Tour. Monday, the Italian delighted the home fans as he dispatched Jesper de Jong, extending his current win streak to 23 matches. And don't forget, you can watch all the action live daily on Tennis Channel.